So they're saying that this ECB opinion, if it comes to fruition, could talk about a 35 basis point impact on their capital leverage requirement. So really keep an eye on that one as well. And pharma stocks, again, rolling in the background, getting several regulatory approvals for likes of Sanofi and Roche. That might shake this market up, Guy.
Yeah, are you going to get pharma sectoral tariffs, tech sectoral tariffs at the same time? I don't know. Anyway, we'll watch this week. It's going to be a bumpy one. Let's start off with the Monday session. Remember, it's a short week as well. We are expecting a move to the upside, fairly dramatic move to the upside for European equities this morning. Does London get left behind because it doesn't have much tech? We'll wait and see. Certainly the DAX, I suspect, with names like Infineon and SAP could do well in this morning's trade. The stock 600 is already up by 0.9% and climbing. The FTSE's up. The FTSE with little tech is climbing this morning, and it's going to be interesting to see what the prime drivers of that are within the mix there. But the IBEX up by 1.75%. We'll wait for the CAC. Remember, LVMH is going to report sales and revenue at around 4:40 London time. There's a call at 5 p.m. London time. You're going to watch that one very carefully, I suspect, out of today into tomorrow. But the CAC this morning up by 1.9%, outperforming the stock 600, which is up by 1.4%. The IBEX is up nearly 2%. Let's see how high the DAX goes when it gets going in a few minutes' time, Chrissy.
The gains are broad, Guy. You're seeing this across the FTSE 100, across the Stock 600 as well. Let's start with the FTSE 100, though, because I think this is interesting. You talk about how it's kind of defying a little bit of gravity here, despite the fact, I should say, you are seeing less tech exposure. Oil markets driving this index. I think it's interesting. You're seeing the likes of Shell, BP, Glencore. A lot of the commodity names are your outperformers this morning, despite the fact that Brent crude is actually flat on the session. I'm looking at a 64 handle there. So interesting to see where it's getting that direction. On the Stock 600, though, you called it. It is tech all the way. ASML is your biggest points contributor to the upside, alongside a little bit of pharma, as we were expecting. So Novo Nordisk, Novartis, a little bit of Roche in there as well. So tech and pharma leading the gains. But again, very, very few stocks in the red this morning.
Yeah, you got down 17 stocks, up 506 stocks. So there's obviously a big move to the upside. And as you say, it is reasonably broad. Be interesting to see how long this tech story lasts, though. Do you get the positive vibe from the fact that they get rolled back, or do you worry more about the fact that they had to be rolled back because that exposes just how deep US tech is into China, and B, the fact that sectoral tariffs are coming? So how long does this tech bump last this week? I think this morning, Freudian slip.
Fair enough. We'll forgive you on that one. I think we're all still waking up. But I think it's crucial that if you talk about this from a fundamental perspective, because look, there's a very real chance that these tech stocks and these that are rallying today are going to sell off big tomorrow as well. That's just a function of the volatility. The other piece of this is that maybe it is a good thing. I'm kind of putting my bull hat on there here. Maybe it is a good thing that any sort of tariffs that we do get aren't going to be the 145%. That is a very high number. So to beat that,
it is.
The barrier is high. The bar is high.
I know, but the problem with that argument is that you assume the higher it goes, the worse it gets. There is a point at which you get to where it's just the damage has already been done.
Yeah.
And anything beyond that doesn't actually have that much of an effect. So I don't know where the numbers are, but say it's at 70%. So say they're brought in at 70%. Is there a difference between 70% and 145%? I don't know.
Yeah.
But there is a kind of 70% is still a bad number.
Oh, absolutely. It's still a bad number. But it's, I suppose for Europe, it's a good number if you're an ASML and you're making the equipment that makes the chips, because it's still going to be in demand, right? So from a fundamental perspective, there is this kind of divergence, I would say, from some of them.
Maybe.
I'm trying to be an optimist. You gotta give me a little credit here, Guy. You know how hard that is to be
on a Monday morning.
On a Monday morning, and for me as well, I prefer the gloomy stuff is way more fun. We are waiting for the DAX, I should say. It's 8:03. I'm not seeing an early pricing on it just yet, but again, we are seeing some of the individual movers show up in the kind of stock 600 pricing. I'm looking at early pricings of Infineon, which are already higher by about 4.3%, and I jinxed it. There it is.
To the upside.
So that's your outperformer this morning, right next to the CAC, by the way. So LVMH ahead of those earnings, also driving it. Let's see if this sticks and bring in a true expert. Kevin Gordon, senior investment strategist over at Charles Schwab, has made the trek from the United States and joins us around the table. What are you hearing from the clients you speak to in the States and globally? Because there's this narrative circulating that Europe is the safe haven now of the world in this kind of flight away from American assets. How much power does that argument have?
Yeah, I mean, it works with a pretty long lag, especially because of our, U.S. investor base being so, biased towards the U.S., not only because it may be what they know, but also because of the dominance and the outperformance over such a long period of time. So we've certainly been, pounding the table, especially our international team, over almost the past calendar year, where you want to have more exposure, more diversification across developed and to some extent emerging markets, but definitely have a bias more towards developed international. But, it works with a pretty long lag. And even though you've gone through this pretty dramatic narrative shift over the past couple of weeks, I do think that, and you guys have been covering it really well, I do think that the decline in the dollar, to the extent that that continues and starts to show at least a little bit of a chipping or a fraying in this U.S. exceptionalism narrative that has been so strong for so long, if that continues, then you probably start to see at some point more of a bias towards, non-U.S. equities.
What does that do, though, in terms of kind of the reaction function of buying American equities? You would think that a cheaper dollar would make kind of the math around entering the U.S. market more attractive, not less.
Yeah, I think so. I mean, and again, this is I think a small mover or an elongated move, small right now, and it'll take probably time to play out. And the psychology of markets is such that, when we go through these massive events, especially, shocks that are quite literally man-made, supply shocks that are quite literally man-made, where we don't really have a history book to use, the bias is to try to say, okay, is this a zero-sum game? Is it dumping U.S. at the expense, or is it going into, international markets at the expense of U.S.? We don't really see it that way. We see a more, level playing field where you should have exposure everywhere. But because their clients have been so underexposed to non-U.S. markets, whether it's in equities or fixed income, it's probably makes sense to have a gradual shift and a gradual change in your view over time.
How gradual? This is the question that I think a lot of people are asking themselves at the moment when they look at their portfolios.
Yeah.
Do I take a gradual approach, or are things moving too fast to be gradual?
No, I think gradual makes sense because, what gets lost, I think, a lot in the whole discussion around a global trade war, which this certainly is that there's virtually no pocket of the world that is not exposed. So It's not as if the U.S. is the only one that's going to hurt from this. Clearly, other parts of the world are at risk. I mean, if you're going through, and I think this is the difficulty in ultimately trying to get to the essence of what, at least from the standpoint of the United States, what the goal is of this, which none of us know really, in trying to figure that out, is this really a reshifting of the global trade order as the U.S. sees it or not? If it is, then I think that, we're probably dealing with much more existential issues, but again, that is not something that's going to be solved over time. So you're really looking at a shift in a freight liner. Certainly the U.S. is trying to do it, the administration is trying to do it, at with like a speedboat, but it doesn't happen that way.
Are there going to be better opportunities to invest further down the road? Because this is so do I keep cash? Do I hold cash at the moment and wait for those opportunities?
Well, certainly the prospect of holding cash, at least in the near term, has continued to look attractive. I mean, especially if you think about the Fed staying in wait-and-see mode and really not trying to move dramatically one way or the other. I think probably for a longer period of time, cash is still relatively attractive because, if you think about this from the perspective of the Fed, wanting to move aggressively to the downside in terms of cutting rates is still really tough to do, especially because they have been relying, and we've all been relying, on relatively resilient, backward-looking, hard economic data, but that's all we can do. So if that's still the case and they don't see any major deterioration in the economy, especially the U.S. labor market, then there's probably not a bias to cut, and you probably have cash looking relatively attractive.
So what's the canary in the coal mine for you? You're talking about waiting for this data, at least from the Federal Reserve, but from your perspective, The UMISH data is brutal.
Yeah.
The inflation expectations data is brutal. You are seeing maybe not widespread layoffs, but early signs of it, even pre this kind of tariff concern in some of the beige book as well. There are some minor cracks in this economy. At what point do you say, okay, this is the recession indicator?
I do think that, you know, all roads lead back to the labor market. And the big question now that we're still asking ourselves is there still this huge gap or a really long lead time between the soft data and the hard data? We're starting to see clearly a deterioration in the soft data. That is more, you know, sort of crisis-like, instant supply shock-like.
Things like claims are still holding up.
Exactly. So there's not as much when you start to look at the hard data. There's not as much of a you know feed through. The filter effect is pretty strong still, where all of that confidence and sentiment still is rough and really depressed. Really almost depression-like levels when you look at some of the UMISH data. A lot of it's at all-time lows. Expectations for income gains, inflation-adjusted income gains, household finances. I mean, you could go down the list. It is really at dour levels, but it's not yet filtering over to the labor market. And I wonder if it's going to take probably until, honestly, mid to late summer to see that actually filter over, if it does. If it doesn't, then you go through another, you know, vibe session where the vibes looked really poor, but it didn't necessarily transfer over into the hard data. I think that, you know, we're at a different part of the cycle where the soft data probably does lead the hard data, because when you think about the last time we had this, 2021, 2022, yes, the soft data was deteriorating quite rapidly, but that was also happening as the U.S. labor market was rebounding rather strongly. We do not have the latter case this time.
Just thinking about pricing equities, do I need to assume higher treasuries yields? Like, how do I think about equities going forward in a world that looks like we're going to have higher treasury yields, just from a kind of supply and demand, deficit, all these other arguments that are driving the treasury market?
Yeah.
How do I price equities right now,
you know,
given that?
Well, in terms of yields, I think there's often a lot of focus, and, you know, rightly so, especially when you talk about the large cap, small cap debate on levels. The rate of change and the direction of yields tends to matter more in terms of the instant moves for stocks. So when we think about the inflation backdrop and the relationship between bond yields and stock prices, the fact that we have kind of slowly drifted over the past 4 years, slowly drifted into this negative territory where all else equal, which of course is not always the case, but all else equal, when bond yields are going up, it's putting downward pressure on stock prices and then vice versa. So if that continues, then you probably have a little bit more of a less friendly relationship. I wouldn't call it hostile like we saw from the 70s to the 90s, but you probably have a less friendly relationship between the two asset classes. In terms of pricing from a valuation standpoint, I think this is really interesting for this year, because similar to 2020 and 21, when we saw a record number of companies, at least in the U.S., pull their guidance for earnings, valuation analysis was basically useless. I find that we're probably slipping into a similar environment today. Yeah, because, I mean, if you think about all of the weakness for equities, at least in the case of the United States, which is, you know, what I cover and where I live, the compression has been all multiple driven. It's been all multiple contraction. So a lot of people will point to the E component and say, well, forward earnings are still going up, so it's fine. I mean, you can't really rely on that metric. So if forward earnings estimates are going to continue to go up, that's actually going to put, all else equal, upward pressure on multiples. But of course, we know that's not necessarily the case right now. So I think it makes, similar to 2020 and 21, again, it makes valuation analysis not very helpful, if probably, you know, just not useless at this point.
Why is that not the case right now, though? And I give the example of last week we covered Delta suspending their guidance. We covered Walmart with their suspending their operating income guidance. It feels like we're there. Why do you say we're not?
Well, you haven't yet seen this, I think, overall avalanche. I mean, those have been early reports. And also, if you get down to the nitty-gritty, I'm not an analyst for individual stocks, but looking at some of the language from even both of those reports, you've got one company being on the discretionary side of things, the other company being on the staples side of things. With the staples company actually not issuing terrible guidance in terms of their, at least this year, but the other one really taking a step back and saying, well, because of all of the presumed weakness from an input cost side of things, but also from a consumer spending side of things, there's probably more, of
Are there
dark
stocks
cloud
you
hanging
will watch
over.
specifically? Like, is there anything coming up that you're going? I know you're not a single stock guy, but what's the reporting season? What are you watching for?
Well, the banks have certainly. I mean, you made this point earlier. The banks, I think, have been helpful in terms of the state of things right now. Unfortunately, we don't really get a sense of that until real time. So I think by the summer, again, once we get a better read on if delinquency rates are going much higher, or if the consumer really is stepping back in terms of spending, we'll have some data that lead us up until that point. But I am much more focused on the companies that are definitely more exposed, especially in all the tariff news over the weekend, the companies that are most exposed from an input side of things. Because so much of the focus for tariffs is often on the end final packaged consumer good, I think there's not enough focus on the inputs themselves, because you could be exempt from tariffs, presumably, for a finished good, but not exempt from an input side of things. So if we're still going to rely on those in the U.S., then there's still a lot of exposure to that trade war from a multi-country
Takes a while to get through the supply chain to figure out exactly what is happening.
Absolutely.
Kevin, great to see you. Thanks for stopping by to see us on this side of the pond. Kevin Gordon, Senior Investment Strategist at Charles Schwab. Thank you very much indeed. Let's take a quick look at the call stakes this morning, figure out what is happening there. Remember, we get LVMH sales and trading a little bit later on today. LVMH is up this morning. Unsurprisingly, it is some of the tech names that are doing better. So ASML is rising quite nicely, but actually, the standout story this morning is in the pharma space. Novo's up over 3%. Let's talk about some of the other single stock moves that we're watching. Joe has the details.
So as you mentioned, Guy, the tech stocks doing pretty well this morning. Pretty significant gains across the chip makers. We're seeing rises for ASML, as you mentioned there. Also BE Semi, Infineon, ST Micro moving as well. But it's not just the chip makers that are moving higher. We're also seeing some moves in some of the hardware makers as well. Logitech, remember, one of the firms absolutely hit by tariff worries. That one coming up 5%. And GN Store Nord, more known for its hearing aids, but actually makes headphones as well that are used for personal devices. So we are seeing broad moves higher on hopes around these potential exemptions by Trump, although, of course, watered down very slightly since those initial headlines. Then we're seeing the car makers also having a pretty good day as well on news of the EU and China working towards some kind of agreement on the import of Chinese EVs into Europe, potentially looking at minimum pricing rather than tariffs as well. So that one seems to be a positive for the auto stocks. We're seeing the German names moving higher on that one. Then BNP Paribas, this is related to the company's purchase of an asset management business from AXA, and we had an ECB ruling or an ECB opinion on the asset implications of that. Potentially, it is going to mean they have a lot less capital on the books, but potentially a bit better than expected, according to analysts. So BNP, one of the best performing banks today, gaining 4%, a pretty decent move higher for that one. Then in terms of Salzgitter, probably not as bad as the decline I had expected on that for Salzgitter, down 1.6% at the moment in Germany. Remember, a deal for the company, a takeover, actually falling apart according to a report out from our deals team over the weekend. And then one more to bring you was Wood Group. Take a look at this one, 25% gain at the open, now up 18%. The company getting a takeover bid from Sidara, the company that actually made a proposal around a year ago, then walked away because they couldn't agree on a final price. But they have got another bid coming up for the stock. That stock now trading at 29.50, but around a year ago, it traded for 200 pence. It's absolutely cratered on worries about debt, but getting a bit of reprieve today. Wood Group down in the UK, small cap oil stocks gaining 18% in London at the moment.
Joe Easton from our equities team walking us through some of those early moves. We thank you so much. Coming up on the program, European chip stocks on the rise this morning, as Joe just mentioned. President Trump exempting certain electronics from tariffs, but saying more sectoral tariffs may be on the way. How do you digest it all? We're going to dive into the details next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology driving business across Europe.
Companies in Asia are betting on tech.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Monday morning, good morning. European stocks are higher. We've gapped first thing this morning. Tech is doing some of the heavy lifting. Pharma's doing some of the heavy lifting as well. But let's focus on what is happening with the technology story. European chip stocks are a big driver of the narrative this morning. We have an exclusion that comes through from the Trump administration late Friday on smartphones and other forms of tech as well. They've rode that back to a certain extent over the weekend as well, calling it temporary. But President Trump said there isn't a tariff exemption for certain electronics, promising that nobody is, quote, off the hook. Peter Elstrom has been tracking this story for us and is here to walk us through what we see next. Peter, I find it fascinating. TSMC overnight gapped higher first thing in Taiwan and then has faded. The fear has got to be, therefore, that actually the rates ultimately are still going to be fairly prohibitive for Chinese Asian tech going into the United States.
We had a lot of drama over the weekend, and I think investors are still trying to sort out exactly what it all means. As you mentioned, we got this exemption that was filed with the U.S. Customs and Border Agency over the weekend where smartphones and PCs, iPads are going to be exempted from this 125% tariff on China, which is a big deal. It looked like a big win for Apple and for NVIDIA and for some of the others also. Then first Howard Lutnick came out and said that this is only going to be a temporary reprieve. And then we got Trump saying nobody is off the hook. Everybody's going to have to face these tariffs. I think the bottom line is investors still have to find out more information. The Trump administration has talked about how this week they're going to start to explain what these sector tariffs on semiconductors are going to be. That's going to take a while, though. It's going to take some time to play out. It probably, though, is going to result on tariffs being much lower than that 125% level. The key question is whether the tariffs are going to end up being leveled on the phones, the entire value of the phones in Apple's case with the iPhone, or just the chips themselves, which is a much lower number. That's a key thing that we don't know yet.
There is a thought on Wall Street, led by Dan Ives, of course, the Uber bull from Wedbush around tech, that even just the volatility of not knowing for, say, 30 days could have a 10 or 15% hit on tech capex. In this kind of bracing of what tariffs come and whether they're sectoral or whether they're reciprocal or whatever that is, how much damage is this doing to tech companies that are actually trying to make changes and operate?
Well, tech companies are making decisions on a completely different time frame than the administration. As we were just talking about, the policies appear to change very dramatically over 48 hours at a time. When Apple is talking about building facilities to be able to make its iPhones, it has to make decisions on a decades-long basis. Tim Cook is the guy who built this supply chain through China. He took a risk. He built these plants within China, making a bet that they were going to be able to produce there and ship into the United States. It worked brilliantly for a long period of time, but now what we're seeing is that these tariffs are going to force them to make some changes. Apple, of course, is shifting some production into India. One of their goals is to be able to make a bunch of the iPhones that they sell in the United States out of India and ship them in, but it remains to be seen whether they can do that for a very substantial percentage of their iPhones.
All right, Bloomberg's Peter Elstrom digesting the news just as we are drinking out of a fire hose, it seems, everywhere. We thank you so much for your time. Well, that market turbulence, of course, it's not just in the tech space, it's in the banking space as well. Wall Street banks continue to report earnings with the results from Goldman Sachs due later today. Now, JP Morgan was part of the first wave of lenders reporting on Friday. On the earnings call, CEO Jamie Dimon warned of some of the market turbulence that Peter was just talking about. Take a listen to what he had to say.
You're going to hear 1,000 companies report, and they're going to tell you what their guidance is. My guess is a lot will remove it. They're going to tell you what they think it might do to their customers, their base, their earnings, their costs, their tariffs. It's different for every company, but I assume you'll see that. And anecdotally, a lot of people are not doing things because of this. They're going to wait and see.
Bloomberg's Charlie Wells is here to walk us through it. People are not doing things to wait and see. The words of Jamie Dimon, I mean, he's basically realizing the fears that everyone has. Everyone's just going to brace for impact.
This is exactly right. And I mean, it's funny if you compare that to what Ted Pick said on the call at Morgan Stanley, which was somewhat similar. And he was talking about how, you know, we're seeing a pause, not a delete. And so there's this real kind of difficulty, I would say, maybe kind of somersaulting in how these executives this earnings season are kind of dealing with that uncertainty. And Bloomberg actually counted the number of times that executives on these calls said some variant of the word uncertainty, and it has skyrocketed compared to what it has been in previous quarters. So that really is kind of the theme of the day.
What do we get from GS?
Probably blowout on equities trading. I think that would be very much in line with what we've been seeing at these other banks. I think very much in line with what we've been seeing at these other banks. Who cares? Because I think there's two questions. One is the deal flow, right?
Yep.
Pause, not delete. I think we might see a similar theme at Goldman. But also, you know, how they navigate this uncertain environment.
In some ways, they're a trading house in a way that JP Morgan isn't. JP Morgan is a much bigger cross kind of market bank.
Exactly.
Does this mean that Goldman Sachs is either better positioned or worse positioned? I can't quite work out which.
I think right now it's looking like bigger and more diversified is better. I think especially if the economy goes into a recession, which these executives have been really, really quick to say, no, we don't necessarily think this is happening, but we're ready for that. But I think in the event that that happens, the more diversification that you have, I think the better, particularly if those deals just are not paused and they are deleted.
Do they build out their reserves? Just very quickly, Jamie Dimon and JP Morgan talking about building out their reserves, and they did to the tune of almost $1 billion, but it wasn't that much.
No, it wasn't that much. And then also, the things that they said were kind of not necessarily in line with a huge reserve build-out, right? They were talking about the confidence of the consumer. And, you know, Jeremy Barnum, CFO at JP Morgan, talked about how, you know, as long as the labor market stays in a pretty healthy position, the consumer should be pretty healthy too. Wells Fargo also reported last week, and they talked about how the consumer is in a pretty good place too, which doesn't really jive with what we've been hearing about fears about inflation, fears about these tariffs and stockpiling, right? People, and also some data showing consumers are kind of paying the least amount that they have to on credit cards. So I think this all means it's really early days. We're not necessarily seeing that play out in the numbers yet.
Charlie, great stuff. Thank you very much indeed. We'll look forward to those numbers a little bit later on. As I said on Friday, I'm sure Sonali Basak will be all over that news a little bit later on in the US session. European banks, let's take a quick look at where we sit this morning. Generally up quite nicely. Deutsche is up by 4.5%. One of the best performers within the DAX this morning, which is being dominated by some of the tech names as we see that space moving higher as well. What are we going to be talking about next? Nuru Rabini is going to be joining us. We'll talk to him about what he sees next. That's next. This is Bloomberg.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know. This sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
no, you can do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is the opening trade. 30 minutes in today's session and broad gains across the board. You're seeing this across the equity indices across Europe, higher by 2% on the stock 600. The outperformer is clearly the DAX. You're looking at massive gains for the likes of Deutsche Bank, SAP, Infineon. Buy everything seems to be the mantra in Europe, but does it stick? This is the equity picture. In the bond market, a similar one. People buying bonds across various regions here. I want to bring your attention to two key places. Italy, of course, getting an upgrade from S&P over the weekend. You're seeing a bid into that bond market as well as into the UK, that yield down by about 5 basis points, just as the currency rises across the board. Euro at 113, pound at 131.
Yeah, off earlier highs though. We got a 114 handle a little earlier when it came to euro dollar. Let's focus our attention on what is happening in Europe, or what Europe is doing in the rest of the world. The European Union very much racing to try and get trade deals done with countries around the planet, looking basically to diversify. I can't talk this Monday morning. I blame Rory McIlroy. Against an increasingly protectionist United States. Let's get a take now from Bloomberg's Ollie Crook. Ollie, Sefcovic has been in the States. He's trying to get a deal done. He's trying to figure out what's happening. He's talking to other people. What is going on? Bring us up to speed.
Yeah, so Guy, Sefcovic is going to have his meetings in D.C. today with his counterparts and various other officials of the Trump administration. As you say, Guy, I think the real task for the European policymakers and European leaders here is to get a concrete idea of what exactly the Trump administration wants. We know what they want, broadly speaking. They want to close the trade gap between Europe and the United States. They talk about these sort of non-tariff barriers, all of these sort of other things. They need to get their arms around what the Trump administration explicitly wants from them, because up until this point, they have not really been able to. We also will have Giorgia Meloni. She'll be heading to D.C. later in the week. She is seen as sort of one of the political leaders here in Europe that has a sort of closest relationship with Donald Trump. Can they make any progress? And this all to bring some certainty to what has been a very chaotic system over the last couple of weeks. You had 3 basically different global tariff concepts that governed last week through Monday, Tuesday, Wednesday, Thursday, and that is something they'd like to bring a close to. What I have gotten from all the finance ministers and trade ministers that I've spoken to over the last week or so has been that basically, despite the fact of whatever happens in the United States, the Europeans want to negotiate outcome. What is guaranteed is that Europe will hasten its efforts to build free trade agreements with the rest of the world. Remember, there's the Mercosur deal, which was sort of agreed to in principle at the end of last year. That is with Latin America. There are talks about free trade arrangements with the UAE. All of those things are still in motion. However, European leaders and European policymakers so far have stopped short of saying that they really want to completely reevaluate their relationship with China, which they still consider to be a competitor and really a threat to the European economy.
Well, Ollie, expand on that relationship here, because Pedro Sanchez has made, I believe, 3 trips in the last 18 months to China. Are we seeing any consensus being built around his position from some of his other European peers?
I think that he has failed to really get the European leaders and European policymakers to rally behind him in his effort to do that. We had to have him speaking, alongside Xi Jinping on Friday, and really starting to make the case for basically building a closer relationship with China, which he says, and I think which the Chinese say, in some ways a more reliable trading partner than the Trump administration right now. That being said, I will say that the Europeans are very reticent to basically throw out 80 years of diplomacy due to the way that Donald Trump has been sort of behaving over the last couple of weeks and months. Though, however, of course, Kriti, that could change as time evolves, right? In terms of the reality of what the actual Trump administration wants to get out of them. But for the time being, everyone I've spoken to, even the Spanish economy minister, was sort of putting a little bit of cold water on the notion that you'd have anytime soon a rapprochement between the Europeans and the Chinese.
Bloomberg's Oliver Crook there walking us through some of the European dynamics as they struggle to really balance the demands from the West, perhaps looking to the East. Let's continue that conversation about what's going on in China, specifically as we talk about this idea of whether they're prepared for this trade war. I want to bring in a true expert here. Diana Choi-Leva, chief economist over at Noto Economics, joins the program. Diana, a pleasure to have you as always. The conversation we've been having this morning is that we're seeing so much kind of tit for tat in terms of trade. How insulated is the Chinese economy right now from the ripple effects, from the impact of Donald Trump's tariff agenda?
Clearly, the all-out tariff war is going to hurt China, but China's had 10 years to prepare for this. And what we are seeing is Beijing basically realizing that there is no way to appease Washington. On the other side of the equation, there's also no way for China to really give the U.S. what the U.S. would want and reach this sort of grand bargain that we talk or maybe we hope for. So in the end, really, this is an all-out ideological great power competition that now is in the economic domain.
Diana, talk to us about then the market domain, perhaps, because we're talking a lot about whether or not at the end of the day, the Chinese, even though they do have had 10 years to prepare, as you point out, are actively selling American assets. Are you seeing any evidence of that?
Look, I have not seen any evidence of that, but this is certainly something they can utilize, a weapon they can utilize in the short term. Over the long term, it's an own goal and certainly not something that they would like to deploy. They have been much more focused on diplomacy, actually, on that front, and on building and seeing an opportunity to expand their geopolitical sphere of influence.
Dana, good morning. It's Guy. Scott Bessent, the U.S. Treasury Secretary, is using George Kennan-like language. He's talking about economic containment of China. In that kind of a scenario, does Europe have to pick sides?
Absolutely. Everyone will have to pick a side. And the reason why everyone will have to pick a side is actually technology. And no one is as ahead of the game in terms of technology as China and the U.S., so Europe cannot be a separate pole in a multipolar world. They have to pick a side.
So in terms of what we're seeing at the moment, there seems to be this belief within European capitals in Brussels that there should be outreach to China. Is that a mistake?
Look, it depends how you look at it. From my perspective, I've grown up in communism, and I personally don't want to live in communism again. It's important to me that the free, liberal, democratic world is as strong as possible. And actually, it will be able to be strong if the US and Europe work together, in particular with India as well in the mix. However, if the U.S. is not prepared to work as a credible and reliable ally, Europe has no choice but to try and scramble and achieve some sort of independent strategic autonomy, but it really starts too late. So this is a very precarious position for Europe and could even lead to Europe's breakup, because there's certainly differences in the European capitals with respect to how to deal with Beijing.
Diana, when we talk about that kind of preparation for this restructuring of global trade, there's a question from a lot of major American, I would argue European corporates as well, that they don't want to stick with their supply chains in China, but reposition to the likes of India, Vietnam, Cambodia, et cetera. To what extent does that undermine the China bull case?
Look, the China bull case is actually at the moment has nothing to do with exports. What has happened in China is, for the first time ever since September last year, they're finally realizing they have to get their consumption going. And that's a very different story. On the export side, we have seen that the Trump administration in particular wants to close the loopholes of Chinese exports, basically round-tripping through other locations in Asia. So it's no longer really a safe strategy for corporates to think about relocating to places like Vietnam or Cambodia. You have to really start differentiating or sort of dividing the world of where you think each country is going to fall, in which sphere of influence, and build your supply chains accordingly.
Sorry, okay, let's just take this a little bit further. A moment ago, you said that Europe could break up as a result of this twin power spheres of influence world that we are now moving into. Is that how big a risk is that? Could you see one part of Europe in the American sphere of influence and one part of Europe in the Chinese sphere of influence?
Look, I'm not an expert on Europe, but what I do see is that before the Russian war on Ukraine, actually that was a more likely outcome. I think post the war in Ukraine, China really lost Europe. Of course, Beijing is now in overdrive to try and take advantage of Trump's presidency. And it really depends on how the geopolitics fall out here and what happens both with America's position with respect to Russia's invasion of Ukraine as well as China's.
What kind of growth should we be looking for in a world that is as divided as you suggest that we may be, a divided scenario that we may be heading into? Globalization has had lots and lots of effects. As we start to unwind that, as we tear these two big superpower economic forces apart, what is the economic effect of that globally in aggregate?
It's stagflationary. And in particular, it's stagflationary in the inflation or stagnation part will, of course, depend on domestic policies and on the leeway or scope each country has to ameliorate this, invariably cost-push inflationary pressure from the breaking up of the supply chains. And so it's a very, very difficult situation for the global economy, one where it's difficult to foresee how the chips will fall. You know that I have been talking about the great decoupling since 2017 and sort of foresaw everything that we are seeing right now. At the moment, we are in the eye of the storm.
Chips falling, I guess that is the story right now. The chips are the story. Diana, always great to catch up. Thank you very much indeed for joining us. Diana Choileva, United Economics Chief Economist. We're going to be back with more. We're going to carry on this conversation. That's next. This is Bloomberg.
so important to you?
It's our state's largest city. And if your state's largest city is not thriving, your state can't thrive. And that is just a mathematical equation, because the only way this is going to be Maryland's decade is if it's Baltimore's time. And so that's why we did focus on things like being able to extend the Orioles lease and make sure the Orioles could be here for 30 years. It's the reason we focus on things like the Preakness and keeping the Preakness in Maryland for generations to come, while we've invested in the convention center. The reason we focused on housing and getting rid of the vacant housing. The reason we focused on violent crime. And now Baltimore is having amongst the most precipitous drop of anywhere in the country when it comes to homicides and non-fatal shootings and carjackings and auto thefts. So if you can have Baltimore thriving, your state is going to thrive.
So if somebody's watching this and they're not from Maryland, but they want to know a little bit about Maryland, what would you encapsulate in a paragraph or two about what people should know about the state of Maryland?
I would say Maryland really is American miniature. You tell me what you want to do. And no matter where you're standing in the state of Maryland, I can tell you where to have a world-class experience within 2 hours. We're the home of innovation. We're the home of Johns Hopkins University, the home of the NSA, the home of NIST. We have so much to offer in the state of Maryland, and I think it's one of the reasons that people are so excited about the growth trajectory we're on.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Monday morning, good morning, 14th. You got European equities a little bit higher this morning. I say a little bit higher. We're up by circa 2%. Tech's having a reasonably good morning. You're seeing pharma stocks doing reasonably well. Actually, some of the commodities stocks are also doing fairly well as well. We are, though, keeping a very firm eye on what is happening with the dollar. The buck is under pressure. Euro's been in and around 114 for most of the morning. You've had a fairly big move in Japanese 30 years as well, which is worth paying attention to. There's a lot of different forces kind of moving around at the moment. So let's try and pull them all together, try and get some signal out of the noise. Nouriel Roubini, CEO of Roubini Macro Associates, joins us now. Nouriel, good morning. Let's talk a little bit about signal and noise. How much signal are you able to see at the moment in all the noise at the moment? What are you watching to figure out what happens next?
Well, there are three scenarios that are important for the global economy markets. One in which you de-escalate not only with friends and allies, but also with China, and you start negotiation. If that's successful, then you avoid the U.S. and global recession. Markets are going to be higher all over the world by the end of the year. The other extreme scenario is one in which there is a failure of negotiation, even with friends and allies, let alone with China. Then we end up in the U.S. and a global recession, an ugly one. But the more likely scenario is the middle one in which you have successful trade negotiation to de-escalate with Europe, Japan, Taiwan, India, South Korea, and you name it, but not with China. And if you don't start negotiation with China, the trade level of tariffs are such that then inflation is much higher in U.S., there is a growth shock in China, and you can still get a near recession in U.S. and in China that then damages the world economy and damages the market. So I think that unfortunately we're in this limbo right now. There is a chance the U.S. and China may start negotiations. If they do start negotiation, they could try to reach a grand bargain, but the ask of the U.S. out of China might be too much for China to accept. So those negotiations may still fail.
Nouriel, what's on the table here? You think about the kind of the spectrum of what we're thinking about. Bessant's talking about what sounds like, as I was just talking about, Kennan-like containment of China, that we're basically going to tear the global economy into two competing spheres of influence. He wants to use the rest of the world to ring-fence China and to isolate China. In that kind of a world, how long is it going to take? How long is it going to take to get to a steady state in which we don't have the kind of volatility that we've got now? How long is it going to take to reorder the global economy into that kind of a new world?
Well, if you're really trying to contain China, is not just a trade war, but restriction to technology, to financial activity, to investment both ways, and so on, imply a strategy of full economic containment of China, what China is really worrying about. The US is trying to prevent the rise of China. If you do that, you have a risk of a true war, because the only thing that is constraining China from going and trying to take over Taiwan, either through an invasion or a blockade, is the fact that they know that the US might punish China by doing what they've done with Russia, meaning total trade embargo, no economic activity with China, and that would be highly painful for China. But if you are going to a world of trade tariffs of 145%, of full economic containment, then that leads to a trade war that becomes an economic war, that leads then to this Cold War becoming colder, and eventually a hot war in the case of Taiwan. Why should China restrain itself with Taiwan and not take it over if it is losing the global markets of the US? Might as well start to that. And it's not obvious that the US is going to reply to that by breaking a blockade, because that's not just a war with China. It's not just a conventional war with China, because either side is going to either win or lose, and then it becomes an unconventional war, and then it's the end of the world. So those who think that they can contain China, I think they're really playing with fire, because that's very, very dangerous. What you can do is to do a grand bargain with China, where you do a deal where you de-risk the relation of China by decoupling in technology, because the things that are critical to US and China, there has to be full decoupling, but then you do trade on everything else. We don't care about Chinese toys or consumer products being cheap in US. We're worried about advanced tech or EVs or semiconductors or things of that sort. So if you reach a grand bargain, then you still have a division of the world in two, but it is a technological division. It is not a full decoupling, it's de-risking what's important.
Well, Nouriel, walk us through then the levers that China can use here. There's a lot of speculation about whether or not China is selling treasuries, whether they're looking to devalue their currency further. What kind of response can we expect from China in the days and weeks to come? As you point out, the U.S. looks to contain it.
Well, there are things you can do for the domestic economy. You can do massive additional fiscal stimulus. You can do further monetary easing. You can gradually weaken your currency, but of course, with tariffs at 145, if you let your currency so much lower, then there is a risk of capital flight in spite of capital control. You can do structural reforms to reduce the savings rate and increase domestic consumption. It implies to creating a social safety net. You're already replying to the US by imposing tariffs of 125%. Of course, given the trade imbalance, the US hit on China is worse than the one that China can impose on the US. But then there are lots of other things. You can shut down the exports of rare metals to the United States. Most of the refining of even industrial and green metals like copper occur in China, not the production, but the refining. You can shut down that. You can go after Tesla. You can go after Apple. You can go after hundreds of billions of dollars of US economic interest and FDI in China. You can do lots of things. And as I said, you can then become more aggressive with Taiwan as well. So there's a whole spectrum of things China can do. By the way, China and Xi Jinping do not face election. Next is the midterm election in the US that could lead, if there is an economic recession, to the MAGA project failing miserably. He can wait out the United States. So in the short run, China has a lot of leverage. In the medium term, of course, a trade war like this hurts China more than the US, because China is exporting 2% of its GDP to the US. If that goes to zero, it's a huge economic shock.
Well, Nouriel, in terms of the economic shock, I'm curious about, I mean, you just laid out all the levers that China can pull. To what extent is the volatility around these tariff announcements doing more damage than the rate itself, in that corporations from both sides of the Atlantic and both sides of the Pacific are just trying to work out what the number applied to some of their goods actually is? How much of that volatility and that bracing for impact is amplifying the odds of a recession?
Certainly, the volatility on top of the tariffs increases the uncertainty, and there is an option value of waiting. If you're a corporation, You may say, let me wait and see until I do more investment, more employment, more domestic or foreign investment. Same thing for consumers. But it's not just the more domestic or foreign investment. Same thing for consumers. But it's not just the volatility and uncertainty matters, because the level of tariff matters. I mean, if we end up with certain economic tariffs by the U.S. against China of 145%, and you're certain about them, there's no uncertainty, the economic pain is severe, regardless of. So this argument is all about the uncertainty. If we only knew what the tariff will be okay, is not true, because if the tariffs against Europe, Japan, China, India, and others remain very high, there is a huge economic and financial market damage, even if there is zero uncertainty. So it's not just an uncertainty problem, it's also the economic damage of this trade war that is a problem.
Yeah. Nouriel Roubini, CEO of Roubini Macro Associates. Oh, losing my voice there. We thank you so much for joining the program. Of course, as we were talking then about what that volatility actually looks like, that uncertainty that Nouriel was just talking about, how do you position for it? Let's bring in Bloomberg's Valerie Teitel, who is trying to work that out. Val, what do you do?
Buy gold. I think that's what the market's told us. I mean, just take a look at how gold's been outperforming. I mean, even on a 5-year historical basis now, outperforming the S&P 500. You know, I say that with a laugh, but at the same time, you know, gold can be telling us various things, Guy. And I think perhaps maybe one of those things it's telling us is that there essentially is a risk that the U.S. tries to inflate away their debt pile, and that perhaps these treasuries end up being on the Fed's balance sheet because, frankly, if they're not going to foreigner investors, if they're not going to banks, where else are they going to go?
Who else is going to buy them?
Yeah, exactly. And I think that, you know, the Treasury Secretary, Scott Bessent, was speaking to Fox News this weekend, and he was talking up the prospect of banking reform in order to allow banks to hold more treasuries. So maybe there is a start of realization that they need to get going on this kind of banking regulation.
Good for banks or bad for banks?
Well, you could argue it's bad for U.S. growth, right? If U.S. banks are in some way, maybe not forced, but in some way are more pursued to hold more treasuries on their balance sheet, they're doing less active lending to other parts of the economy. But at the end of the day, if that's growth negative, this goes into that whole debt circle discussion again. Your debt to GDP rises, which means you need to cut government spending, which means you have more treasury supply that needs to be absorbed by the market.
How quickly does that happen?
That is another good question. Yeah, no, that's another good question. I mean, we saw these same dynamics happen in the UK around the Liz Truss scenario. And I think the big takeaway from that is that the bond market, the government bond market, is too big, and you need to be careful about trying to change the boat over what kind of growth you're going for, right? And with President Donald Trump, you know, trying to rewire global trade, reducing the trade deficit, is really posing questions about the buyers of treasuries. The same kind of question that we had here in the UK around the Liz Truss epidemic. But I'm starting to get real concerned about this kind of price action, especially if we see on a day like today where they've done some tariff reprieve and we still have 30-year yields trickling higher. It does not put us on a good firm footing going ahead.
I feel like we had this conversation in like the third quarter of 2023, and here we are.
Here we are again.
Yeah. And really the dynamics haven't changed. We just have a different president, which is fascinating. Bloomberg's Valerie Teitel walking us through some of these markets. We thank you so much. And speaking of that bond market, the behemoth, that of course is driving a lot of these other ripple effects. We're going to have an exclusive conversation that's incredibly relevant. U.S. Treasury Secretary Scott Bessent will be joining Bloomberg TV this afternoon. You can catch that interview on television, I believe on radio as well. Our very own Anne-Marie Hordern in Argentina for that. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Monday morning, good morning. European stocks, US futures rising. This despite President Trump pledging tariffs are still coming on smartphones, computers, chips, etc., etc. He's saying that no one's off the hook. The market's okay this morning on that narrative. The dollar is continuing to decline. The greenback falling for a 5th day to the 6-month low. Tariff saga rolls on. Plus, the Chinese President Xi Jinping heading to Southeast Asia as he looks to form alliances in the trade war with the United States. Let's talk about the markets. Let's figure out what is happening this Monday morning. Other than the fact that Rory McIlroy won the Masters, there are a few other things going on that you probably need to pay attention to. US futures are higher. The US 10-year actually is catching a bid today. The 30-year obviously has been on the move a great deal over the last few days. Euro dollar, we had a 114 handle a little bit earlier on. We faded that move a little bit, but not by much. Still 113.88. We've got an ECB meeting coming up this week. And you've got Brent crude trading at 64.92. We're up by a little bit there. But keep an eye on what that crude price is doing. Quite a good reflection of what is happening with the global economy. European equities generally quite well bid this morning. You've got pharma stocks doing well. Names like Novo Nordisk doing very well. But you've also got the chip stocks rallying quite nicely. That is lifting Germany. The German equity market is up by 2.29% and is outperforming. France is up quite nicely as well. LVMH post-sales and revenue numbers at around 4:40 London time this afternoon. You are definitely going to want to pay attention to that. So there's a lot going on this Monday morning. I do think it's appropriate that the European markets are all in green this morning. I think it's just in honour of Rory McIlroy winning that green jacket last night. Okay, let's get going.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Morning, folks. Welcome to the show. Fran's off today, but I'll be with you for the next couple of days. Then you've got Anna for a couple of days, but she'll be back soon, I promise. I just want to show you what is happening with the European chip story this morning. Plus, I want to fold in a little bit of Apple. We've got pre-market trade now starting in the United States. Chips are generally reasonably well bid, as you can see. ASML, STM, Infineon, BE, all trading nicely to the upside this morning. Let's take a quick look at where Apple is pre-market as well, just to give you an idea of how that's being folded, that story is being folded into the United States. We'll get that brought up in just a second. Basically, what has happened over the weekend is we have ended up with an exemption for the smartphone sector, for the chip sector, but that's not going to be permanent. Lutnick comes out over the weekend and basically says this is not permanent. Then Trump comes out and basically says nobody is off the hook. This is what he had to say on Air Force One.
The tariffs will be in place in the not-distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future.
What rate the semiconductor tariff?
I'm going to be announcing it over the next week.
Potentially as early as today. Let's get a take on this from Bill Ferris, who's going to walk us through all of this. Bill, we get a relief rally because there is an expectation that actually maybe these tariffs are going to be lower than the 145 that's being applied to China. But do we know how much lower, and do we know how long it's going to take to get there? What do we know at this point, and what do we not know?
Well, yeah, after this last week when we've seen these things come into effect and then get quickly reversed, the administration is really pushing back on the idea that it's stepping away from this strategy of tariffs. So, yes, consumer electronics, things like those iPhone and Samsung imports into the United States, they're not going to face that 145% tariff now and maybe never. We just don't know. What the administration is saying now is that they're going to create a special bucket for those kind of products that have semiconductors. They're going to look at having a special tariff applied to those kind of goods. Howard Lutnick saying that there will be some sort of an announcement in the Federal Register perhaps this week, perhaps today, we don't know, that talks about what those tariff levels would be and what the timeline is. That timeline would be expected to be a couple months at the earliest. And that would allow a lot of time for feedback from companies and a lot of time to lobby. We do expect some kind of tariffs based on what President Trump is saying, but we certainly don't expect them to be anywhere near as high as 145%.
What do you do if you're a corporation? What do you do if you're a company? What do you do if you're a business that has a supply chain? We're being whipsawed here at the moment. What are we hearing from the companies that actually have to use this kit?
Yeah, I don't think the volatility is going to go away in the short term, but I think you're going to see more of what we saw in the days and the weeks leading up to the reciprocal tariff deadline last week, which was companies are either trying to rapidly get their products into the United States and perhaps stockpile, build up some inventories that can provide a little bit of a buffer for them, or we've seen companies suspending orders, pausing until they get a little bit more certainty. That's certainly something that the smaller companies have been doing. So I think it gives them more time for that. We know Apple has looked at, for instance, looking at pushing more iPhone supply through India. It can't replace the entire U.S. market from its supplies in India, but it can certainly push more iPhones into the States in the coming 90 days or 60 days or whatever they think they have until new tariffs come into place.
Bloomberg Senior Editor Bill Ferris, thank you very much indeed. That's the kind of U.S. side of the fence. Let's talk about what is happening in Asia right now. The Chinese president, Xi Jinping, touching down in Vietnam. Obviously, he's on some sort of a tour to garner support as China figures out how to deal with what is happening with the tariffs. So remember, everybody else got a tariff pause. China didn't. So we've got this trip now to Southeast Asia. He's looking for alliances. Is he going to find them? And is he going to find them in Hanoi? Let's get an answer to all of these questions. Bloomberg's China and Economy government editor Alan Wong joining us now. Talk to us about what are the wins that Xi Jinping is looking for here? What is the objective of this tour?
Yeah, so President Xi Jinping of China just landed in Vietnam a couple hours ago. This is coming just a couple of days after Trump gave everybody else a pause on the massive tariffs that he imposed, calling them reciprocal tariffs. But China didn't get that, and then the tariff level is at 145%, which we expect to wipe out basically virtually all trade between China and the U.S. Well, what does Xi Jinping want from this trip? First of all, it's not necessarily about gaining; it's about defending. Because we know the Trump administration wants those three Southeast Asian countries, Vietnam, Malaysia, and Cambodia, to help in its fight against China, specifically to prevent the transshipment of Chinese exports through those countries into the United States, which is a way that the Trump administration thinks amounts to dodging the tariffs. So what Beijing would want from this trip is to make sure that its neighbors doesn't sell it out for a better deal with Trump. We know that all three of those countries are actively seeking to negotiate with Trump for a deal. So the baseline expectation for Xi Jinping would be that they do not settle their dispute with Trump at the expense of Beijing's own exports.
Alan, thanks for the update. We'll watch for headlines. Alan Wong joining us on what Xi Jinping is hoping to achieve this week. So in terms of the market perspective on all of this, dollar a little bit lower, down for a fifth day. Donald Trump downplaying his exemption on the technology sector. That seems to be causing a little bit of volatility. European equities, though, broadly catching a bid this morning. US futures are in the green. So you've got a mixed asset story. Paul Kines, Global Head of Equities at JP Morgan Asset Management, joining me around the table. Are we heading for another week of volatility? Does it kind of feel like that?
Absolutely. So I've been doing this 40 years now. Last week was right up there with some of the wildest times we've seen. It's hard to believe it now. The S&P was up 6% last week. And twice within an hour on Monday and Wednesday, we had a year's worth of returns, an 8% gain. So we've seen a lot of volatility, but of course in both directions. It's not going to end right here. But hopefully, as time passes, investors start to get a bit more sense of what's going on, a little bit more confidence in starting to think about how to price stocks again.
I'm assuming we need to wait for earnings season to be over before we get that. And the problem with the earnings season story is it's going to deliver, I suspect, not much guidance. So that clarity maybe you're talking about, is it going to come from corporations? And if we don't have that guidance to price stocks, how accurate is our stock pricing?
Yeah. So, sure, the companies are still trying to figure out what's going on to recalibrate, and they've got to think about two things, right? The direct hit from the tariffs, the impact that has on their businesses, which in some cases is very significant. We were just talking about some of those. In other cases, much less. And then the broader impact of probably a more challenging economic environment they're going to see for a while than any of us were expecting until a couple of weeks ago. And that's going to have broader impact across the whole corporate sector too. So I think the key thing in the earnings season, how are companies reacting? They're probably going to post pretty good results for Q1. We think Q1 was solid, but it's all about what they do next. Do they suspend their guidance? We've seen some of that. Do they start to step up a little bit and talk about buying back more stock, which is a tool that's always available to companies, of course, in uncertain times. A lot of companies were perhaps holding back a little bit there because the prices were high. Well, now prices have moved more in that direction. So just passing through all of that is certainly what our investors are going to be spending time on in the next few weeks, looking for clues and looking for opportunities. You don't need certainty to buy stocks. You find good companies at lower prices, you're going to get some great opportunities.
But are there better opportunities further down the road? Does the volatility produce greater volatility? Is there a temptation as an investor maybe to hang on to cash right now and think about and hope for maybe better opportunities to get in at a later date?
Always tempted to do that, but timing the markets...
Sure.
Very hard.
You're going to tell me that you should stay invested, but people are beginning to question that right now.
Right. Look, the advice we give on that, over time, equities make you money, right? Most of our clients make most of their money in the stock markets. But the returns don't come smoothly. They don't come easy. So first of all, every year, you've got to expect some volatility. We're in a pit start right now. Secondly, if you look back over the last 20 years, the 10% return you've had on owning stocks in the US drops to 6% if you miss the 10 best days.
Sure.
So that's 1 day in 500. We've already seen a couple of those just in the last couple of weeks. So it's hard to do.
I get that, but there are key moments in time. So 1929, you get the crash. It takes until 1954 to get back to where you were going into the 1929 crash. 2000, the market comes down. Takes another, 7 or 8 years to get back to where you were. So I hear what you're saying, but are there moments in time when that doesn't apply?
I do think there are things investors can do to help through this period, right? So I think this year, more than ever, paying attention to some of the time-honored principles, diversification is your friend. That's never more true than when things are tough. And then valuation matters as well. And thinking about having a truly diversified portfolio with valuation on your side, that's an important thing to do. And I think it's particularly important right now, after a decade in which the returns in equity markets have really come from sort of one place, right? The best growth stocks in the US. And those are still amazing companies, but I think you want to think about a more diversified approach from here.
Geographically?
Two things. Geographically, I think Europe earns its place in the portfolio from here.
Right.
So it hasn't for a long time. Right? European stocks have underperformed US stocks by 7 percentage points a year for the last 15 years. Most of that's come from lower fundamental earnings growth.
And that valuation gap's going to close, you think?
But the valuation gap has now opened up and is wide enough that even if, in our assessment, if American companies on average continue to grow more quickly, and they probably will, then you're paid enough to invest in Europe too. So European returns can be competitive because the valuation starting point is so much lower than it used to be. And the other point, and I mentioned value too. The best returns have come from growth investing. We know that. But over long periods of time, value's been your friend as well. Value's been making a bit of a stealth comeback here in the last couple of years. Value's been working in Europe. Value's been working in Asia. Only in the US have we not seen that. In the first quarter, value stocks actually up 2% in the US compared to growth stocks down, 7 or 8, something like that. So are investors evenly balanced between growth and value, as I think they probably should be? Maybe some of them have had a lot more money in growth over the years and need to pay attention to that side of the portfolio again as well.
Also in a diversified portfolio, what else am I putting in there? Gold. What else goes into that mix to diversify me against what is happening at the moment? A lot of people clearly are looking at gold in a way that they haven't done for quite some time. Treasuries normally acted as the ballast on the other side of the portfolio. Do I need to... Is the ballast different and more diversified in this world that we're in now?
Yeah, so look, in our team, we focus on trying to... We follow about 2,500 companies around the world, so we just try and make the most of that. I think, much as I love equities is never going to be all your exposure, but I think it remains the core.
Is it difficult to... The relationship between bonds and bonds and equities, how are you on the equity side of the fence seeing that right now?
Yeah.
As you try and value stocks, what kind of discount rate are you thinking about going forward?
Yeah. So the most important, so what we really watch from the fixed income markets is signs of credit stress, right? That's the thing that we've learned in previous crises is a very important warning signal for equities that are kind of exposed there. So far, that's been reasonably benign. We've seen obviously some rising credit spreads around the world, particularly in the US, but that isn't sending us those kind of super warning messages yet. So we've got a close eye on that, but it isn't telling us anything too bad at this point.
So in terms of the kind of the bigger picture at the moment, your attitude would be diversify your portfolio, keep diversifying your portfolio. Does that in theory, therefore, just implies flows out of the United States? Is that something that, and how long does that last for? How long do you think it's going to take before we get to a point where actually most portfolios are more balanced?
Yeah, so everyone's starting point is different, right? It's very hard to call that one. There are going to be people, we've read a lot in recent years about this enormous amount of cash sitting on the sidelines.
Yeah.
It's all there. And I think some of this is going to be addressed by, as people think about putting money to work in these markets, trying to take advantage of lower prices, thinking about where they put it, not just always going back to the same 7 names that have driven all the attention over the last... I don't know why people use Magnificent Seven, by the way. In the movie, only 3 of them survived, so it's not a great lesson.
We're not going to pick which ones are going to survive this time around. But is the volatility at the moment just telling people broadly to take more risk, to take less risk? If I'm a portfolio manager, if I'm a trader at the moment, I've definitely got a risk manager tapping me on the shoulder going, reduce your risk positions right now. Is that something that investors more broadly should take on board as well? Is this an environment to take less risk?
The first thing you've got to do in environments like this, and we've learned this in previous crises, is make sure you're not overly exposed, right? And fundamentals have changed for some companies. Making sure that you don't own too many of those, that's what people were doing kind of early last week. But I think we're through that phase now. We've found that some of the best opportunities for stock picking have come in the aftermath of crises, right? So 2009...
Are we in the aftermath yet?
Probably not there yet, but we're heading there, and we're closer than we were a week ago.
Yes.
But just remembering that. So post-GFC, 2021, after Pfizer Monday, and as the fog cleared a bit from COVID, owning great companies at great prices, there are some fantastic opportunities that come from that.
But is it more difficult when you've got such key man risk in Trump? Is it how much harder does that become? In as much as you just don't know where the volatility is coming. I can price risk, I can see those risks, I can understand those risks. But when you have something as idiosyncratic as Trump and the effect that he's having, can I make those same sort of valuation judgments in this world?
It's always hard. So think about the aftermath of COVID. We didn't know what was going on. We hadn't lived through a panic. In hindsight, it feels okay because that volatility's gone away. We just look at the fantastic returns that followed. But it's always really, really hard at the time. And there are always compelling reasons not to invest and not to take risks.
You also had the Fed pushing liquidity into...
You had that too. But staying focused on company fundamentals and the prices you're paying, that is the best thing you can do.
Great to see you, Paul. Thanks for stopping by. Lively discussion. Paul Kines, Global Head of Equities at JP Morgan Asset Management. Thank you very much indeed. Coming up, we'll talk about one subsector of the equity space. European chip stocks certainly on the rise this morning. This after President Trump exempted certain electronics from the current tariffs, but not for long. Nobody apparently is off the hook. We're going to talk about that story next. This is Bloomberg.
Geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Past the hour. European equities are higher this morning. Chip stocks are leading the charge. This after we saw the move out of the administration over the weekend to exempt smartphones and other tech imports, though apparently not for long. Peter Elstrom joining me around the table to talk us through all of this. We know that there were very high tariffs. We know that they were exempted. We know that that's not going to last for long. We just don't know what we go to ultimately. What do we know about where we go to ultimately?
Well, there is a lot of uncertainty here. What we found out late on Friday night is that certain products are going to be exempt from that 125% tariff from China into the United States. And a big deal was made out of that. Apple in particular, some of the other companies that are playing in this space breathed a big sigh of relief that they were able to get this. But very quickly, the Trump administration came forward and said they're not completely off the hook here. That 125% tariff may be off the table at this point, but they're going to begin a process to look at what kind of chip tariffs are going to be implemented right now. So it's not like the iPhones, the Mac laptops, et cetera, are going to be exempt from these tariffs. We just don't know exactly what they are going to be. So I think what we're seeing in the market in Europe and probably in the U.S. after this is a sigh of relief that these tariffs are not going into effect right away. They're probably not going to be as high as expected, but we don't know what they're going to be. So companies are having a hard time making decisions at this point about what their strategy is going to be if they have this much uncertainty.
You and I were chatting a little bit earlier, and I was posing a question to you about why TSMC started the session in Asia and Taiwan up and then faded.
Right.
Did we figure anything out?
Well, we have some hints of a solution at this point.
Do you know what's right on
Peter?
What
is Japan High, of course, is the most important manufacturer for Apple and the iPhones right now. We saw them jump quite a bit after this news, and they remained up. So they're up quite high. They finished the session up more than 3%, as I recall. Now, TSMC is in a different position. They make the chips for Apple and the iPhones, and they also make chips for NVIDIA. What they're trying to do right now, though, is build a bunch of factories in the United States. It does look like when they buy chip-making equipment from companies like ASML, Tokyo Electron, Applied Materials, they're going to have to pay tariffs on that. What we saw from the Trump administration over the weekend is an exemption that signals later on that chip-making equipment is going to be subject to certain tariffs. Again, we don't know exactly what that's going to be, but it wasn't clear because it's been so important for the United States to rebuild some of its chip-making industry. It wasn't clear that that chip-making equipment was going to be subject to tariffs. Now it looks like they probably will be.
You can always rely on Peter for a smart answer. Thank you very much indeed. Peter Elstrom joining us on what is happening in the tech space. Let's move on and talk about what is happening in the financial space, the banks in particular. So we had JP Morgan out with numbers Friday. Later today, we get Goldman Sachs. We obviously had Wells and JP Friday, Morgan Stanley out as well. We learned a lot at that point, but it's going to be really interesting to see what Goldman Sachs has to say a little bit later on today. Let's talk about the earnings call, though, with JPM. Jamie was on that call. Jamie Dimon was on that call, warning of market turbulence heading into this earnings season. Ted Pick was on the Morgan Stanley call. He's talking about saying the firm doesn't actually know yet where all this trade story is going to settle.
You're going to hear 1,000 companies report, and they're going to tell you what their guidance is. My guess is a lot will remove it. They're going to tell you what they think it might do to their customers, their base, their earnings, their costs, their tariffs. It's different for every company, but I assume you'll see that. And anecdotally, a lot of people are not doing things because of this. They're going to wait and see.
As the year progresses, markets will calibrate further clarity on trade policy against the tax and deregulatory pillars of the agenda as the U.S. endeavors to rebalance the fiscal equation and assert the national interest. Given this unpredictability, some clients are deferring strategic activity while others are proceeding.
Ted Pick, Jamie Dimon. Charlie Wells is here around the table talking about the banking sector. What do we know so far? We're going to get Goldman Sachs a little bit later on, but what was the takeaway Friday?
I just thought of a pun. Can I share it with you?
Yeah, go.
Cautious optimism. That's what I'm seeing here. So Ted Pick talked about how we're seeing a pause, not a delete on the deal front. And if you go back and look at those earnings transcripts, which I would really encourage people to do, and watch out for the blogging on Goldman today, there's this kind of sense of optimism here, and it's pegged to this idea that if the Trump team can get this trade issue resolved quickly, things are going to be okay, right? The deals will come back. They're just shelved for now. They will come back. The consumer's going to be okay. I'm calling it cautious optimism.
Yeah, realistic optimism, I don't know. It doesn't feel like that's the message coming out of the Trump administration right now. So what is Goldman's going to tell us today?
So look, they're probably going to have really good news from the past. So on that equities trading that we saw so much volatility. That's always good for them. But it's about deals, right? Again, it's like they are just so exposed on that deal front. What do they get there? And I think another issue that we really should be paying attention to is wealth management, because Morgan Stanley missed on that front, and it's looking like it's not going to be amazing news for Goldman either. And I think this is the question that a lot of analysts have. Wealth is good, I mean, in a lot of ways, but it's good in turbulent times, right? Because you get those fees coming in no matter what's happening. But if they continue to miss, what's going on there? What happens if we get into a
why do you think? Do we get any clues as to why?
I mean, there's some theories about asset mix, right? That clients are going more into these kind of like less fee-generating assets. That could be a part of it. But I think we're going to see maybe if there's more analyst questions on this, because if you get this kind of pattern forming, what's happening there?
We're going to watch very carefully a little bit later on. Charlie, Shanali, all the great team lined up to work our way through these banking earnings. We'll have that for you a little bit later on. Coming up on this show, though, the EU racing to clinch deals around the world, trade deals around the world. Obviously, it's seeing relations with the United States soaring. We're going to look at what the bloc is going to be focusing on this morning. We'll do that next.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Monday morning, good morning, welcome to The Pulse. I'm Guy Johnson. Let's talk about your top stories this Monday morning. European stocks and US futures are rising, despite President Trump pledging tariffs are still coming on smartphones, computers and other electronics. Apparently he's saying that no one is off the hook on this matter. The dollar is also under pressure, the greenback falling for a fifth day to a six-month low as the tariff saga rolls on. Plus, the Chinese President Xi Jinping heading to Southeast Asia as he looks to form alliances in the trade war with the United States. Let's talk about markets. Let's talk about kind of where we are this morning and figure it all out, at least for now, for the next 5 minutes. Who knows what's going to happen 5 minutes down the road. Let's start with the European Union, actually. It's racing. It's trying to figure out if it can do deals around the world to try and offset some of the turbulence it's seeing, particularly with its relationship with the United States. How feasible is this going to be? Maroš Šefčovič is going to be in the United States a little bit later on. Let's get a sense of how these negotiations are going. Ollie Crook joins us on this matter. Ollie, give us an update.
Yeah, so Guy, what the Europeans are really aiming to do is to negotiate trade deals, as you're alluding to, around the world. There was the Mercosur deal that was struck at the end of last year, sort of tentatively. The French and some others had some notable issues with it to try to get it through. But these are the kinds of things, the uncertainty around the Trump proposals around tariff, that really put pressure and accelerate these deals getting done. We've had the EU also talking about a free trade agreement with the UAE. These are all the sorts of conversations that I've been having over the last week with finance ministers and trade ministers trying to reevaluate the landscape. But the main deal that everybody wants to strike, Guy, is with the United States. That is still the primary objective of policymakers here in Europe. You have Maroš Šefčovič, who's going to be in D.C. today to have conversations with his counterparts to try to get his head around and try to get the European head collectively around what precisely the Trump administration wants out of Europe, other than just closing this trade barrier. We also have the question of Giorgia Meloni. She'll be there on Thursday as well to talk with Donald Trump. And when you think about the sort of all the leaders and all the people who've tried to get an audience with the Trump administration, I managed to catch up on Friday with the president of Switzerland, who actually managed to have a call with Friday, with Trump on Wednesday. Right before that, have a listen to what she had to say.
I could explain that to the U.S. president, which was very helpful. And we also talked, of course, about the tariffs and that, of course, we are unhappy about 31%, which is huge. And so we would like to talk about how, in fact, we can come back to a normal basis of tariffs together. And we both agreed that we have to find a solution.
So she managed to have that conversation with Donald Trump last week, saying that some of the points were getting through. She was making the point that basically Switzerland has a huge economic trading relationship with the United States, not just in the exports, but all the R&D. Apparently, Switzerland and Swiss companies are the #1 spender in terms of R&D in the United States. And then over the weekend, you hear from companies like Novo Nordisk who are saying they're actually now willing to plow $23 billion into the United States over the next 5 years. Are those the kinds of deals that really cut through to the Trump administration and kind of guarantee trade negotiations? Again, everybody is going to try to model their own negotiating tactic in terms of what other countries can secure.
Ollie, great stuff. Thank you very much indeed for the update. We'll look for some of those, look for some of the news out of some of those talks a little bit later on. Let's talk about some of the other stories we're watching this Monday morning. UK officials are rushing to secure the raw materials needed to keep Britain's last primary steel manufacturer up and running, British Steel. The government passed an emergency bill Saturday to take control of the steelmaker after talks with its Chinese owner broke down. The UK Business Secretary, Jonathan Reynolds, spoke about the takeover from an emergency session in the House of Commons.
Since taking office, this government has been negotiating in good faith with British Steel's owners, Xingye. We have worked tirelessly to find a way forward, making a generous offer of support to British Steel that included sensible, common sense conditions to protect the workforce, to protect taxpayers' money, and create a commercially viable company for the future.
Situation in the UK. Euro area inflation will turn out slower than previously forecast because of higher US tariffs. That's according to a Bloomberg survey that supports the case for the ECB to cut interest rates this week. Some economists predict further cuts in April and in June. Isabel Mateos Ilago, Chief Economist of BNP Paribas, joining me around the table. Good morning.
Good morning, Guy.
So what does the ECB do this week? What should the ECB do this week?
Well, they're going to cut.
Yep.
But the most important part is going to be the narrative around that, the signal, any guidance that they can give to the future. Until recently, there was seemingly a debate amongst the members of the Governing Council as to whether what would dominate what would be the deflationary impact of the US tariffs or the supposedly inflationary impact of retaliation from Europe and others. I think at this stage, it's overwhelmingly clear that the deflationary impact dominates, so they're going to cut. But I think there are still going to be probably some saying, but you need to keep in mind all this stimulus coming from the German fiscal spending, etc. Now, realistically, that will come on stream much further down the line. So I think they should also make clear that if things continue on the path they're on, they're likely to cut in June as well, and that right now the overwhelming concern is growth and the disinflationary impulse. But hopefully they can provide that sort of guidance.
Let's assume that 2 is neutral. Do we go below 2?
Well, that's a big assumption. We don't know if 2 is neutral. And frankly, in the near term, with all the uncertainty that is in the environment right now, you could even argue that maybe it's lower. So that's something else I need to take into account.
So how far do you think ultimately they could go, though?
2 seems like a good level, because I think it's remarkable how Europe has been getting its act together, responding in a way that supports domestic growth, trying to do trade deal with others. And so I'm not too worried about a bad growth outcome for Europe. In fact, I think we're going to see a continued strengthening of growth in Europe, and that too is going to be the right floor.
Does the fiscal that we're seeing, particularly out of Germany, offset the uncertainty that we're seeing out of the United States?
Ultimately, yes, but exactly, how the uncertainty is right now. The German stimulus is going to be over the next few years. And so I think certainly 2025 and right now in 2025 is tough, and probably the downside, the headwinds dominate. But as you go out in time, all the positive impacts of the German stimulus, of the European defense stimulus, and the structural measures are going to compound one another. And so I'm actually quite optimistic for the growth trajectory of Europe between now and 2027.
Do you think the uncertainty, though, will cause European corporates to invest less? And why would you invest right now?
Well, right now is not so much why would you invest, but where and how is just really complicated. But it seems to me that ultimately you're going to want to invest in the place where you have most certainty about the policy path and the growth path, and that's Europe more than the United States right now.
You could make the argument that you invest in the United States, because if you invest in the United States, you do have policy uncertainty. Once you're there, policy uncertainty is significantly lower.
No, once you're there, it's also very high because the tariffs come in one day, come out the next day. You have no idea what are going to be your financing costs because, you know, there's all the financial volatility that there's been. Right. So I would disagree with that.
Okay. So how much of an effect is... So the bond market's all over the place, financing costs are all over the place. How big an effect is that having? Because that has there's a gravitational effect out of the Treasury market into Europe as well.
That's very clear. And in fact, you could argue that this has been, if it continues, it's going to allow Europe to finance its stimulus at a much lower interest rate than would have been the case otherwise. You know, last week, the Treasuries, the 10-year went up 40 basis points. Yep. Typically, and even as recently as back in January, when that happened, European rates went up by more or less the same amount. Last week, the German bonds were pretty much stable. This is extraordinary. Yeah. This is telling you there is a lot of capital coming from the US to finance this extra European spending.
That comes with a cost of a higher currency. Is that going to be a headwind?
I'm not sure. Right now, that's another point for the ECB to consider. Yeah. It's making energy imports and all other imports cheaper. So I would say it's a plus right now.
So if you're getting a deflationary narrative, that enhances that deflationary narrative.
It enhances it, but it also, in the near term, it helps the ECB make that extra cut that the economy needs, and probably also the June one.
Isabel, great to see you. Thank you very much for coming to see us. Isabel Mateos-Ilogo joining us from BNP Paribas. Let's turn our attention to what else is happening in the world. My favourite story of the morning, 14 years of trying. It's been a decade, it's been a long decade. Rory McIlroy has realised his lifetime ambition of achieving golfing immortality. He won last night at Augusta. It was pretty dramatic. So at around midnight, he drops a shot on the 18th. It gets really tense at that point. Rose is on the practice ground. We then get a playoff with Rose. They come down the 18th. Justin Rose doesn't manage to keep the momentum he's had in his incredible round, and Rory sinks to his knees. He's finally won a green jacket. An amazing night, I have to say. I'm feeling a little bit worse for wear this morning, having got up in the middle of the night to listen to all of that. Anyway, congratulations, Rory. Well done. Finally, the green jacket for you. Okay, we're going to carry on the conversation around the markets a little bit later on. We'll talk about what is happening with the oil markets as well. We'll do that in just a moment. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
His agenda can be summarized as prosperity at home and peace abroad. Lower oil prices help both of those. And the peace abroad that's of most concern right now in the region where I am, in the Middle East, is Iran. Iran, during the Biden administration, Oil prices were higher. There was sort of an appeasement attitude and no strong enforcement of sanctions, enormous funding to Hamas, to Hezbollah, to the Houthis, and a rapid advancement of their nuclear program. President Trump's agenda is exactly the opposite of that. It's peace through strength, but we simply cannot and will not accept a nuclear-armed Iran.
Well, when it comes to Iran, we saw even more sanctions on the regime yesterday. When it comes to these oil sanctions, the president has said he wants to go back to maximum pressure. Is that part of the conversation you're having with Gulf allies on this tour, that they'd be willing to step in if some of those Iranian barrels come off the market?
Well, fortunately, just from the United States production itself and the size of the global oil market today, absolutely we can tolerate squeezing out Iranian exports. And of course, do all the Gulf neighbors want the same thing we want? Yes. Do they fear a nuclear-armed Iran? Absolutely. Do they think now is the time to turn the screws and end Iran's nuclear weapons program? Absolutely. But yeah, can the world tolerate that? Absolutely. 10 years ago, 20 years ago, could this have happened? No. But today we both have large American oil production, better relations with our neighbors, and a strong, resolute leader. In 40 years of trouble, 45 years of trouble from Iran, we've never had a better chance to reduce Iranian power, reduce Iranian tyranny in the Middle East, and we don't want to miss that opportunity.
Mr. Secretary, the president has said a lot, even recently to me on Air Force One. He likes that oil prices are coming down. Do you and the president have a price in mind?
No, I think my whole life I've avoided predicting prices or dictating prices. You know, we have a wonderful free market economy. That's what makes the world wealthier. That's what allows consumers to continually re-express choices in every direction. So no, there's no formula for a good oil price.
AMH in conversation with the U.S. Energy Secretary while in Abu Dhabi. A Middle East tour taking place at the moment as we see the conversation over the weekend, obviously focusing on Iran and the talks that have taken place there. Iran talking about the fact that those weekend talks delivered constructive conversations. The Saturday meeting, remember, was the first top-level meeting between Washington and Tehran since 2022 and definitely marks a renewed effort to resolve a standoff over Iran's nuclear program. Let's bring in Bloomberg Horizon's Middle East and Africa anchor, Jumana Basetchi. What do we get out of this weekend, Jumana?
Yeah, well, in terms of what we found out about the deal, not a whole lot. But just to point back to what you were saying there, both sides have said that the discussions were constructive. So that's a good start, I would say. And the fact that it even took place shows some improvement in the relationship in terms of where we were just a couple of months ago. And to be clear, there had been a lot of debate going into this about whether the talks are going to be direct or indirect. But what we got at the end of the day was the Iranian foreign minister having these meetings alongside the U.S. Special Envoy to the Middle East and Special Advisor Steve Witkoff. They weren't sitting in the same rooms, so they had 2 hours worth of discussion sitting in separate rooms, but they did speak to each other and greet to each other at the end of those discussions. So both sides have said that the conversations will continue. But at crux here, U.S. want to ensure that Iran don't actually develop a nuclear weapon. And from Iran's perspective, they are looking for sanctions relief. This is an economy that is crippled. The currency has massively devalued. There are shortages in oil and gas and food. And so they're really coming at it from a very weak perspective economically. But at the same time, the fact that the conversations are continuing does suggest that they have stopped short of what Iran called a red line, i.e. some more hawkish members of the U.S. administration, Israel, have been calling for a full dismantlement of Iran's nuclear program. They have said that that is a red line for them. And so what we can sort of piece together and glean from the fact that the conversations are continuing is at this point, the discussions are about no further nuclear enrichment and possible more stringent monitoring of their enrichment program. And I should just say also that the IAEA recently put out a note suggesting that they have actually enriched nuclear material to a sufficient enough point to produce 6 atomic weapons within months. So they are very close to that threshold. And of course, much closer than they were back in 2018, which is when President Trump pulled the U.S. out of that original nuclear deal with Iran.
So is there, just in terms of what happens next, Iran is close. does it basically try and draw these talks out, or is the need for guaranteed sanctions relief so important to it that it's prepared to do a quick deal?
Yeah, so I think, people that we speak to in the space say that it is in their interest to keep these talks going for as long as possible. And also you have to bear in mind that on one hand, yes, the Trump administration is engaging in discussions, but on the other hand, they're also waving a stick. They've talked about this maximum pressure campaign against Iran, about the possibility of even obstructing or applying more sanctions on their oil exports. And by the way, Iran is still producing 3.5 million barrels of oil per day. So we haven't actually seen the impact on the oil markets yet. But to what I was saying earlier, very important for them to get sanctions relief. And we just heard from the Iranian Foreign Ministry about half an hour ago, they saying the guaranteed U.S. sanctions relief is extremely important. In terms of what happens next, the foreign minister is going to Moscow later this week. So interesting there to see what happens from the Russia-Iran perspective. You've got to think that there are some background discussions taking place there too. And then both sides have now confirmed that there will be more discussions taking place on April the 19th. It seems as though this time around the discussions will take place at somewhere in Europe. Vienna or Rome are some of the cities that are being put forward. But the conversations are ongoing. And if they don't lead to anywhere, then of course there is still that potential threat of maximum enforcement, maximum sanctions, and even the, so to speak, nuclear option, military action against Iran.
Okay, we're going to watch the space very carefully. Thanks for the update. Jumana Basetchi joining us out of Dubai. Let's kind of think about where we are with this week and where ultimately we're going. We're coming into a week where we have turbulence already around what's happening with tariffs around technology. We don't know ultimately where that is going to go. It's likely that we're going to see a lower rate than the 145 that is being applied broadly to China. But if you take a step back and think more broadly, it does seem as if the United States is basically trying to pursue some sort of economic containment of China. Now, the question is, does that spread out into something more significant? Remember Kennan, remember the start of the Cold War. Is that kind of where we're at? Because that's the kind of language that Scott Bessent, the Treasury Secretary, is using right now. Let's get a take on this with Fabrice Potier, Chief Executive at the Rasmussen Group and former Director of Policy Planning at NATO. Fabrice, Clausewitz often talked about kind of the interplay between what happens on the military and what happens basically with the economy. I simplify. But are we seeing that at the moment? At the moment, it looks as if the United States is trying to set up a Kennan-like containment of China on the economic front. Is that how you see it? Ultimately, where do you think policy is going to take us from the United States?
Well, if that's the intention, I think that's not going to be the outcome. What you're seeing right now is that you are seeing a kind of rapprochement between China and the European Union, because both are being squeezed, China harder than the European Union by the Trump administration. And they see that at the end, they have to turn to what is the next best economic partner. And the European Union is obviously a very important market for China. And China is a very important manufacturing base and market also for the European Union. So actually, if this is the intention of the Trump administration to contain China, they're making China actually more resilient in terms of its global economic position, because over the last few years, what you have seen is the EU kind of following to a certain degree the US policy of containment towards China. And what you're seeing now is cracks in that alignment, and with the EU being much more, I would say, independent-minded. And there will be normally an EU-China summit in next month, and we might see actually that rapprochement taking full daylight.
So you don't think that Europe is going to have to pick sides?
Well, Europe doesn't like to pick sides. But clearly Europe will have to go for its own interest. And the problem with the Trump tariff war is that it doesn't leave much choice in terms of where do you go? And you have to go with a more European-focused security and defense policy, and you have to go with your best next economic partners. And these are obviously starting with China, but also Japan, Canada, and a few others. So I think Europe is now going for, what's the best next option after the United States. So it's not about choosing, it's about surviving. And I think potentially, like one of your interveners was saying earlier, this could be good on the long term for Europe.
Do you think Europe is playing the China card because of what the United States is doing, because of what the United States wants? Yeah, we might talk to those guys over there if you don't give us a good deal.
I don't think that is that sophisticated and that united. I think it's more that there are some pro-China voices in Europe, mostly from economies like Italy or Spain, or to a certain degree France, who have always been in favor of a better engagement with China. And now they are seeing that there is more daylight between the EU and the US, and therefore arguing for this rapprochement. And again, this is out of economic necessity. If you look at the automotive sector in Europe, this is a sector entering a deep recession, a structural problem about not having taken on the electric vehicle curve. And the Chinese are really ahead of that. So you see a lot of pressure coming from the automotive industry in Europe to argue for better and closer alliances with their Chinese counterparts.
So this isn't a... We're not heading into a bipolar world. This is still a multipolar world that we're going to be operating in.
Exactly, but you will see, I think, a redistribution of what we have seen for the past decades with, for example, a weak dollar, a high level of investment in the United States, and relatively low tariff. Now you have a US that is heading towards a stronger dollar, but possibly lower investment and actually higher tariff. And the EU actually could recalibrate by finally having a stronger currency, more attractive to international investors, bigger investment, especially from the private sector, and possibly slightly higher tariff on certain goods, especially with the United States.
Is everything on the table? A lot of people are speculating about whether or not Chinese holdings of treasuries, for instance, could be part of the economic arsenal that we talk about. Is that something that you would see? Do you think all levers are available to be pulled?
Well, of course, and similarly, everything to do with critical raw materials like lithium, where China holds more or less 90% of the global market, is also on the table without being directly linked to the trade tariff. So I think this is what is at play right now, absolutely.
You mentioned just a moment ago, just very briefly, that Europe is divided. Nouri Rubini was telling me earlier on, there's a possibility that Europe could break into two groups of whether or not it supports the United States or China. How big a risk is that?
I'm not so sure there's going to be such a breakup. I think they will have to find a new kind of policy that is strong enough and not just, a lowest common denominator, given that, again, the EU has to really get on with massive investment, has to show that it can attract international investors. So you can't do that with a lowest common denominator policy. So I don't think it's about the split, as more about finding a really new consensus, economic consensus for Europe. I think the split is more vis-a-vis Russia, where you have a risk that some countries are going to run for cover if the US is disengaging from a security and defense of Europe.
Fabrice, great to catch up. Thank you very much indeed for your analysis. Fabrice Potier, Chief Executive of Rasmussen Global. Let's talk about what is coming up on Bloomberg. Anne-Marie Hordern is going to be speaking to the US Treasury Secretary, Scott Bessent. That conversation is going to be taking place, we think, in Buenos Aires. It's going to come a little bit later on. We are looking forward to hearing what he has to say. Really looking forward to how he is reordering the global economy and his kind of brief around that. Anyway, that conversation is coming up on Bloomberg. Equities are broadly higher right now, but it's going to be a bumpy session, I suspect, once again. Anyway, Danny Berger's next. This is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure. It's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Tech tariff warning. President Trump pledges that he will still apply tariffs to certain electronics, downplaying a weekend exemption. The dollar declined. The greenback drops to a 6-month low on concern that tariff policy will drive traders away from U.S. assets. And we discuss the looming global trade war and market turmoil with Matthias Dopfner, Axel Springer, CEO. I think a lot of people are going to be looking forward to the fact that this is a holiday-shortened week. After the best week for stocks since November 2023, we add some more weight to that rally. Tech outperforming, NASDAQ 100 futures up 1.7%, with tech getting a different band for tariffs. We have still yet to figure out what exactly that will be. I should say the downward sentiment's still out there. Citi downgrading U.S. stocks this week. Speaking of cracks in American exceptionalism, your bond market getting a slight bid. That's off the back of the biggest 30-year increase since 1987. We're lower by 3 and 2.5 basis points for your 2 and 10-year yields. Dollar is at new lows for the year. You can see the euro there stronger by 1/3 of 1%. We're going to get some more data this week. March retail sales, industrial production on Wednesday, and then we will hear from Fed Chair Powell on Wednesday. So those are your overall markets. Let's look at some stocks that we're keeping our eye on as it's 5 a.m. here in New York. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So we are seeing broad-based gains across the tech space in the pre-market trading today. Take a look at Apple. We're up around 5.5% for this stock at the moment. Trump, of course, announcing some exemptions on the tech sector at the weekend, though that has been slightly watered down, as you mentioned there, Danny. Another one moving higher is Dell Technologies. A similar thing. It's those exemptions feeding through into the hardware space as well. And then just on the chips, bear in mind, we did see a big drop in this space on Friday, but some of them coming back up this morning, including Texas Instruments. A good note out from Evercore analysts say they would buy on any weakness linked to Chinese tariffs on semiconductors. And then finally, Goldman Sachs, those equity traders there have been a busy bunch over the past quarter, and we're expecting to see that in the bank's quarterly report when it comes out later today, something we saw from JP Morgan on Friday. And of course, all of these moves and more available on the Before the Bell opening wrap, which is available on the terminal now.
Yeah, we should get those Goldman earnings in about 2.5 hours. Joe, excellent work as always. Bloomberg's Joe Easton will catch up with you later in the hour. Coming up on the show, conversations you do not want to miss. We'll be speaking with Kelsey Barrow of JP Morgan and BlackRock Global Chief Investment Strategist Wei Li. Now, Wei writes this: the pause, of course, that's the tariff pause and reciprocal tariffs of 90 days, suggests that the U.S. administration is taking some account of financial risks and costs, as well as the country's willingness to engage, putting a check on a maximal stance during the negotiations. As a result, we extend our tactical horizon back to 6 months to 12 months, from 3 months to dial up risk. I'm pleased to say that Wei joins us now. Wei, I mean, what a past 2 weeks it's been. It's felt like a decade. But this comes off the back of just last Monday. You had turned more bearish on stocks, downgrading them to neutral. Why the change this time around?
Hi there. Good morning, Danny. Thanks for having me. So the big picture that we have always said is that in the near term, because of policy uncertainty, assets could come under pressure. But over the longer term, fundamentals should prevail, and that should allow us to be more positive on risk. So that big picture has not changed through the course of the last 2 weeks or so. But immediately after Liberation Day, the significant amount of policy uncertainty, and also our sense that it wasn't looking as though any of the checks were having an effect, were binding policy for the administration. That made us feel that we really couldn't see very much further ahead, which is why we shortened the tactical horizon immediately after the Liberation Day from 6 to 12 month horizon to 3 months, because that's how much further we felt that we could see ahead. But as we did that, we also said we didn't know how long or how short that period would be. And then came last week the pause, the walk back, and lots of kind of back and forth, even as that news was breaking. But the big picture here is that the piece that we didn't feel that we had assurance for 1 week ago, i.e. some of the checks and countervailing forces were binding, we were able to get assurance last week that they were indeed binding, be it Treasury bond yields, be it pushback from allies in the business community, but whatever it is, there were binding forces, and that was important for us to have confidence that there is a landing zone over the slightly longer term. And when we said that we didn't know how long or how short it would be, it turned out to be quite short. And then we then felt comfortable to stretch the tactical horizon from 3 months to 6 to 12 months, which is the horizon over which we were a bit more positive because of the still okay fundamentals. I know some of the sentiment indicators were falling quite quickly, but hard data are still holding up. So it very much depends on how long this period of uncertainty lasts.
I was going to say, Wei, because at what point do the headline changes themselves make it too volatile to be overweight on risk assets? You've had 2 U-turns, let's call them, recently, the 90-day reprieve for reciprocal tariffs on tech. But even with tech, we get itself of Trump putting on Truth Social over the weekend saying that no one is exempt, that tariffs are still going to be coming for tech. They are just coming later down the road. Does that type of volatility in itself pose a risk to equity markets, even if there does seem to be some sort of check now?
I will make the broad observation. When you say risk assets, there is equity, there is credit, but I think right now government bonds are also part of that. If you look at the significant rate repricing that we have seen in the last week and longer in the face of inflationary fear, and also term premium going higher because of fiscal concern. So in this environment, when nothing is really risk-free or safe, it's from a whole portfolio perspective, we just gotta kind of think about how we construct a portfolio that can navigate this level of volatility and uncertainty. And I would also say, when we say U.S. equities, we're resuming our overweight over the 6 to 12 month horizon, I would observe actually at times of tariff uncertainty, international markets were not immune. In terms of the correction, peak to trough drawdown after liberation, Japanese equities, European equities, they came under just as much pressure as U.S. equities. The amplification effect of tariffs on a global basis means that there is no country that is really shielded. So we really have to think about it from a kind of a whole portfolio construction perspective. And against that backdrop, I would note that gold has been a better diversifier than treasuries, long duration treasuries, in this environment of inflationary pressure still, and also high debt. The last thing I would say is that in terms of the read across from tariffs to growth, we have the uncertainty effect. The longer it lasts, the more kind of it puts capex and big spending decisions on hold, that feeds through to growth, but it also feeds through to wealth destruction. It feeds through to real income impact because of the tariffs and inflationary effect. So through multiple channels, this can feed through. But right now, it is not for certain that we are heading into recession. Indeed, markets were pricing out one additional cut for this year to be around about 3 cuts. And the longer it lasts, obviously, risks of that increases.
Right. And as you've said, Wei, the fundamentals have still held up. So how important is it going to be to get a read from corporate America in the earnings that we have coming up?
Earnings have been revised lower from mid-teens at the beginning of the year for U.S. equity market to now high single digits. Frankly, there is still room for earnings to be revised even lower because bottom-up analyst revision tends to be a bit slower than top-down revision. Now, having said that, the big picture as I look ahead to earnings season that is starting in earnest, it's not so much about kind of the backward look earnings, which are likely going to paint a picture of still kind of robust resilience. I'm paying attention to forward guidance. Are they willing to give forward guidance? I think some of them will pull forward guidance, but some will give forward guidance. That's important to pay attention to. But also what companies are doing to their kind of international supply chains. Are they changing them? Are they moving them? How are they kind of speaking to kind of cost pressure? These are the things that I'm paying attention to because right now margin is still quite elevated, and we will see if they manage to stay at these levels.
Yeah, we'll see if there are others like Walmart who said that they're basically going to absorb the cost pressure. Wei, it's always such a pleasure to speak with you. Thank you for starting your week with us, Wei Li of BlackRock. Now let's get some other top stories that are trending on the terminal this morning. Italian billionaire Gianluigi Aponte is leading an investor group seeking to buy CK Hutchinson's ports. Sources tell Bloomberg the Ponte family's business will be the sole owner of all the ports, except for 2 in Panama, which will be controlled by BlackRock. The sale has drawn opposition from China and scrutiny from Panama. Elsewhere, Sony raised the price of its PlayStation 5 console by around 25% in Europe and in the UK, all of that ahead of a likely US price hike. The PS5 will cost €500 in Europe and £430 in the UK starting today. Sony cited inflation and a, quote, challenging economic environment. The Federal Aviation Administration ordered tour operator New York Helicopter Charter to cease operations while it reviews its license and safety record following a deadly crash last week. The April 10th Hudson River crash killed the pilot and its 5 passengers, a Siemens executive, his wife, and their 3 children. Coming up on the show, President Trump warns tariffs are coming for electronics, while President Xi tours Southeast Asia. We'll have the latest for you coming up on your Bloomberg Brief. Stay with us.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
The tariffs will be in place in the not distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future.
What rate the semiconductor tariffs?
I'm going to be announcing it over the next week.
President Trump speaking from Air Force One on Sunday, pledging U.S. tariffs will be imposed on phones, computers, and consumer electronics, despite a temporary exemption announced on Friday. For more, we're joined by Bloomberg's executive editor for global tech, Peter Elstrom. Peter, there feels to have been a lot of back and forth. Just catch us up on where we exactly stand with tariffs on electronics.
It was a very dramatic weekend. So very late on Friday, we got notice in a government filing that certain products, including smartphones, the iPhone, Apple's iPhone in particular, other products like the iPad, computers like the Macs, would be exempt from these very high tariffs on goods going from China into the United States. Those are 125% tariffs. That was seen as a very serious threat for Apple in particular, some other companies too, but Apple in particular because they make most of their products within China. They're shipping many of them into the United States too. So that was an exemption on Friday. As we saw over the weekend, though, the Trump administration walked back that exemption. They talked about how these goods are not going to be permanently exempt and that this was a temporary reprieve, in fact. So Howard Lutnick, the Commerce Secretary, first talked about this on the morning shows on Sunday, and then Trump, as you were mentioning, talked about how these tariffs are going to be implemented. They've talked about using something called Section 232 to do this. That's a process that's fairly long. It's pretty open. They get public commentary to try to figure out what those tariffs are going to be. Trump referred to the tariffs on steel in particular. Those are about 25%. So you could see a pretty dramatic come down from 125% to about 25% for some of these products coming from China into the United States, although we don't have those specifics quite yet.
And you can see the market reaction, Peter. It is one of relief, and many analysts saying that you've avoided the worst case scenario. But in the scenario that you're laying out, Peter, where you still have something above 20%, of course, they still have the 20% fentanyl tariffs applied to them. How troubling will that still be for Apple's supply chain, for the big tech players' supply chain?
Well, 25% is serious. Obviously, it's a big chunk of expense for Apple and for customers, probably, but it's much lower than the 125%, which looks like a bit of a crisis. And yeah, even though those tariffs are going to be delayed and eventually implemented, it also gives Apple a fair bit of time to make some decisions now to be able to mitigate those tariffs over the next few months. For example, they're trying to produce out of China. They can ship many of those goods into the United States right now, and they're really ramping up production in India, which is subject to much lower tariffs. We had another exclusive over the weekend that showed that Apple's production in India jumped 60%. They're trying to build more of their iPhones there. They've begun producing their most advanced iPhones, including the titanium iPhone Pro that they make, that they sell. They want to be able to sell as many of those phones from India into the United States because they can then get a lower tariff rate. And they want to make sure that they have diversity of production for the iPhone in particular, but also for the rest of their products like iPads and Mac computers.
Peter, we really appreciate that update. That is Bloomberg's Peter Elstrom. Now, in the meantime, the Chinese Ministry of Commerce released this statement in response to the tariff exemption of those certain consumer electronics. Quote, "This is a small step by the U.S. towards correcting its wrongful action of unilateral reciprocal tariffs. It also urged the U.S. to take a big stride in completely abolishing the wrong action and return to the correct path of resolving differences through equal dialogue based on mutual respect." For more, let's bring in Bloomberg China economy and government editor Alan Wong. Alan, does the reprieve at all represent a thawing of tensions between China and the U.S.?
Well, we thought that it did because, well, the Chinese Commerce Ministry called it a small step in correcting what it called Trump's mistakes. But then after Trump kind of flip-flopped and talked about how those products, including computers and smartphones, will get tariffed later on, albeit probably at a lower rate than 125% that the markets feared, China may have changed its mind. Because if that was one small step in correcting a mistake, then what was this walk back? It's kind of a step going backward. Just before this, we know that China was hit by a massive tariff from Trump after it retaliated, unlike other countries, and China didn't get a 90-day pause. So what happens now is that China needs to figure out how to move forward and to see what Trump will do next, to see if a talk between high-level Chinese and U.S. officials are at all possible.
And President Xi is overseas in Southeast Asia and Vietnam. Alan, how much of that moving on is just about strengthening ties without the U.S.?
Normally, a trip like that would be about China talking to its neighbors to make sure that they're still very much friendly to China, even though they don't agree on everything. But at this time, coming just a couple of days after Trump put massive reciprocal tariffs on China and gave everybody else a 90-day reprieve, the trip has taken on extra meaning. Xi Jinping just landed in Vietnam a couple hours ago, and he's about to meet with his Vietnamese counterpart. China is Vietnam's biggest trade partner, and they will have a lot to talk about. First of all, one thing that will be on Xi Jinping's mind is that he wants to make sure that Vietnam, as well as Malaysia and Cambodia, those countries he's visiting this week, will not sell China out for a deal with Trump. We know that those three countries, they're actively seeking a deal, and some of them said they were sending representatives to Washington to negotiate. China want to make sure that they don't do anything that come at a cost of China. We know that the Trump administration said they want those countries to crack down on what they see as illegal transshipment of Chinese exports through those countries into the United States, trying to dodge the tariffs. But in what forum those three countries will comply with that request, we'll have to wait to see. Over the coming days, we'll see if China reaches new deals with their neighbors. And the other very important thing to look out for is that how those countries think about its position between the U.S. and China. As we've seen before, they would be loath to take a position in this great power rivalry. And so they have to basically walk a tightrope between placating China and the U.S. at the same time.
Alan, a really fantastic setup for what we might see this week. Thank you for joining us. That is Bloomberg's Alan Wong. Coming up on the show, the first all-female crew to space. More on Blue Origin's star-studded flight. That's coming up next.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India but to the planet and the world. And the world needs it now than ever before.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal's going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Welcome back to your Bloomberg Brief. I'm Danny Berger in New York. Let's get you some front page news now. Look at what's making headlines around the world. First up, the New York Times has this on their front page: the results of President Trump's annual physical exam. The president's physician said he, quote, exhibits excellent cognitive and physical health and is fully fit to execute the duties of the president. He also has high cholesterol, which, according to the report, is being treated and is well controlled. Next up, Forbes leads with this: an all-woman crew will be blasting off to space in a live stream launched this morning on a Blue Origin flight. It includes pop star Katy Perry, journalist Gayle King, and Jeff Bezos' fiancée Lauren Sanchez. Kind of wish it was all scientists on the first all-female space trip since 1963, but regardless, we will have live coverage of that space launch. And on the Wall Street Journal, something that I think you all were watching alongside the headlines: what was more volatile, the policy headlines or the Masters? Either way, Rory McIlroy has won the Masters, marking his 5th major title. It makes him the 6th to complete a career Grand Slam by winning all 4 majors. He's the first European to manage it, and the 2nd in the past 50 years. The other is Tiger Woods. Okay, quick check on your equity markets. A rebound on hand with apparent reprieve for electronics. They're still, of course, subject to the 20% fentanyl tariff, and President Trump says that tariffs will be coming for the sector. But still, we're able to rally 1.4% for the NASDAQ 100. Your S&P 500 future session is up 1.2%. By the way, this is off the best week last week since November 2023. Maybe didn't feel that way because of all the volatility. A quick check on currencies this morning, because the Bloomberg dollar spot is at the lows for the year. That dynamic continuing of volatile risk assets and a lower dollar. At what point do you get worried? Your euro stronger by about 0.4%, trading just below 114. Coming up on the show, we're going to be catching up with JP Morgan's Kelsey Barrow on whether there's still a path to avoiding recession and what credit markets look like from here. You're watching Bloomberg Brief.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter, because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Tech tariff warning. President Trump pledges that he will still apply tariffs to certain electronics, downplaying a weekend exemption. Dollar decline. The greenback drops to a 6-month low on concern that tariff policy will drive traders away from U.S. assets. And we discuss the looming global trade war and market turmoil with Matthias Döpfner, Axel Springer CEO. Are you thankful? It's a holiday shortened week. We just have 4 days to get through, and here's the setup for it. It is a rally on hand with outperformance from tech, 1.4%, with on Friday, U.S. Customs saying that they would be exempt from the bulk of China tariffs, still getting that 20% tariff, though, due to fentanyl. President Trump, though, yesterday saying that tariffs will come. Howard Lutnick saying something similar. Despite that, we are still rallying. Citi, though, and Morgan Stanley downgrading their outlook for U.S. stocks just this morning. When it comes to your bond market, we're coming off the back of the biggest 30-year yield increase since 1987. We rally this morning. Yields lower by 4 basis points on the front end, just about 4 for your 10-year yield. We are at 4.45. The dollar, though, that trades at new lows for the year, with your euro just below 1.14. Let's look underneath the surface here with some stocks to watch. Is Bloomberg's Joe Easton. Good morning, Joe.
So we are seeing some big gains in the tech sector today, Danny. Given those headlines you mentioned around the tariff exemptions for the tech space, particularly smartphones, PCs, laptops, that kind of thing. So therefore, Apple, one of the best gainers today. We're up around 5% for the iPhone maker this morning, and also seeing some chip makers gaining as well. Take a look at Texas Instruments, rising following a slump on Friday, as analysts at Evercore say this is the time to buy the chip heavyweight company today. And then in the metal space, a report in the FT saying Trump going to sign an order allowing the stockpiling of some metals, and that is boosting stocks, including TMC. Take a look at that, 20% gain for that stock. And then, of course, it's all eye on Goldman Sachs earnings coming up very shortly. Those equity traders have been very busy over the past quarter, and we're expecting to see that reflected in their quarterly numbers in a few moments, or in a few hours, I should say, and the stock is up around 2% at the moment for Goldman, Danny.
Joe, in this day and world, a few hours goes by in the span of minutes, so I think that is fair to say. Bloomberg's Joe Easton will get those results at about 7:30 a.m. New York time. Now, you have seen some cracks, perhaps, in credit markets. The U.S. leveraged loan market was closed for a second straight week without a deal, and saw the biggest weekly outflow ever last week. In high yield, it saw the largest one since 2005, and there really haven't been any new deals for that market since April 2nd. Pleased to say that joining us now is Kelsey Barrow, Executive Director of Fixed Income at JP Morgan Asset Management. Kelsey, thank you so much for joining. I'm sure it's hard to get away from your desk these days. Look, the credit markets had been holding up remarkably well, but we have started to see some pressure At what point does the pressure become concerning?
So the way that I would look at this is there's cost of credit and there's availability of credit. Right now, credit is available. It's just that companies don't really like the cost. The costs have been rising because spreads have been widening. So you're seeing companies stand down in terms of issuance. But if they did need to issue, we do believe that the market would be there to receive the issuance. And when you look at the past week and what's different about this time versus COVID is that the short-term funding markets are still functioning, and we do think generally credit markets are still functioning. What's happening is a rational repricing wider in spreads to reflect the higher uncertainty and greater risk of recession in this environment.
I'm glad you pointed that out because we did have a lot of talk last week and the week before. Is the Fed going to have to step in because of some sort of dysfunction in the market like we had at COVID? When does it look like that? Just how far away are we from a Fed that needs to step in, driven by the credit market?
So I think we are far away from that. There is essentially two environments where I think the Fed is going to step in. One is a function of credit dysfunction, particularly in the short-term market, so the repo treasury funding market. We're not seeing that. The other would be actually driven by the hard data, and that's the one that I'm more watching. So we still believe that the Fed is ultimately going to be more sensitive to downside growth risks than to upside inflation risks, but they really need to see it in the data itself in order to justify easing policy at this point.
Then what do you make of the recent Fed speak we've had? Because we heard from Kashkari over the weekend speaking to CBS's Face the Nation, saying at the Fed, our job is to keep inflation under control so that rates aren't higher. It seems like that seems to be the conversation, that we need to keep inflation expectations well anchored. But you're saying that they are more sensitive at this point to downside growth than the inflation expectations.
Right. It's just that you haven't seen enough evidence that the labor market is cracking, and that's why they have no reason to respond. I actually think that while survey-based measures of inflation have been concerning, the University of Michigan, again, on Friday, really looking terrible in a lot of different facets, not just higher inflation expectations, but also lower growth expectations and expectations of much higher unemployment in the coming year. But essentially, what I think is more important is I think that the Fed is also looking more at the market-based measures of inflation expectations, which have actually been falling. Outside of the one-year part of the inflation curve, if you look at the CPI swap market, the rest of the market is actually pricing in lower inflation expectations. So it's understanding that this is a one-time hit to inflation, and then the secondary round impacts are actually lower growth and lower demand. And therefore, inflation expectations in the long end, I don't see as becoming unanchored. The move higher in long end yields has been a function of higher real yields. So you have the 30-year real yield at the highest level since the GFC.
I was going to say, given everything you just said, if you didn't look at markets, you'd probably expect yields would have gone down, but we didn't get that. And you also had a weaker dollar. You kind of get this narrative coming for the first time that something has changed, that perhaps we do look like we're something at peak U.S. asset. Does it look like that at all?
So structurally, I do think that there is going to be continued pressure on the dollar, and we may be past that peak in U.S. exceptionalism, but the price action last week really screamed to me more technically oriented than anything else. So we saw unwinds in a number of very crowded, popular macro trades, things like swap spreads, treasury basis, inflation, cross-market trades like U.S. versus Germany. I just think that there was a substantial washout of quite a number of trades that were on a leverage basis that was creating a lot of friction. And one of the telltale signs for me that this was more technically oriented is you had 3 days in a row last week where the 2-year and the 30-year yield went in opposite directions. That is historically rare. And so I'm hopeful that this week, it may be another volatile week for yields, but it should be a week. If it's volatile for yields, it's going to be driven by the economic data, not because of a washout in terms of positioning.
So just to put a bow on it, do treasuries still have a place in portfolios as a ballast, as a haven?
We do believe so. Our range for the 10-year for this year, and it really hasn't changed much despite all this volatility, is 375 to 450 on 10s. We're right at that upper end of the range. I think you want to be smart about about adding duration in your portfolio, but we do think long-term there's still quite attractive value and diversification benefits for having high-quality fixed income in your portfolio.
Kelsey, in this moment of volatility, it's so nice to hear that you are sticking with your targets and with your outlook and your process. Thank you so much for joining this morning. Always a pleasure to catch up with you. That is Kelsey Barrow of JP Morgan Asset Management. Coming up on the show, a conversation you don't want to miss. German billionaire and Axel Springer CEO says if President Trump is serious about America first, it shouldn't mean America alone. He joins the show next. This is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The tariffs will be in place in the not distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future.
What rate of the semiconductor tariff?
I'm going to be announcing it over the next week.
President Trump speaking from Air Force One on Sunday, pledging that U.S. tariffs will be imposed on phones, computers, and popular consumer electronics, despite a temporary exemption announced on Friday. For the latest, we go to Washington, D.C., where Bloomberg's Tyler Kendall joins us. Tyler, where exactly do we stand on tariffs for electronics?
Yeah, hey, Danny. Well, it's unclear how long this reprieve will last because it does appear evident that these tech imports are going to be subject to a Section 232 investigation, which could take weeks or even months. We have to keep in mind that when President Trump signed his original executive order on April 2nd, it always excluded chips and also those other key industries that you heard him mention there, like pharmaceuticals, lumber, and copper, that could be subject to tariffs on the basis of national security concerns. It now appears that these tech imports will fall under that that umbrella, for the sector-specific tariffs, instead of the umbrella of the so-called reciprocal tariffs, as we heard President Trump before saying that they're just moving these from one bucket to another. We have to keep in mind, though, that when this White House has invoked Section 232 before, including on steel and aluminum, as well as auto imports, they've put into place a 25% tariff. That is, of course, much lower than they could have been tariffed if they were subject to the now, for example, 145% tariff against all Chinese goods, but it's still considered to be pretty punitive, because we have to keep in mind that how these sector-specific tariffs are designed, they're typically designed to be stacked on top of any other existing levies. Now, Danny, we have to keep in mind that this latest reprieve applies to about $390 billion worth of imports. About a quarter of that is coming from China. So as these companies try to lobby this White House for any future carve-outs or exemptions, they're really going to be looking at their supply chains and how those could be impacted as these goods get shipped to the U.S. It is something that President Trump said that he was open to yesterday, talking with these companies, saying that he believes there will be some sort of flexibility.
Tyler, you're struck just listening to that by the sheer volume of negotiations that this White House is going to have to undergo. Not just the companies, but we are still on the clock for the 90-day reprieve for reciprocal tariffs. Do we have any insight as to how those country negotiations are going?
Right. So this White House is assuring that there will be some sort of certainty over the next 90 days. But of course, as you well know, it's hard enough to strike a trade deal, let alone in such a short timeline. This administration keeps pointing us to the fact that 75 countries have reached out so far to negotiate. Now, of that, NEC Director Kevin Hassett sort of narrowed the scope last week, saying that there's about 20 countries that they're approaching when it comes to having what he characterized as a sensible deal that they are putting on the table. We know that this White House is also prioritizing those countries that are geographically close to China, like Vietnam, India, South Korea, Japan. Also countries that China's Xi Jinping this week are targeting as well. In Vietnam this morning, saying that he wants to strengthen trade ties with the country there, as this White House really tries to find a way forward. Now, Danny, we could get a little closer of a view about what a potential trade deal could look like, particularly with the European Union later this week. Italian Prime Minister Giorgia Meloni will be here on Thursday and is going to be talking about the full scope of the EU, since the countries got tariffed as a bloc.
Tyler, excellent reporting as always. Bloomberg's Tyler Kendall. And don't miss our exclusive interview with U.S. Treasury Secretary Scott Bessent. He'll be speaking to Bloomberg Surveillance co-host Anne-Marie Hordern from Argentina, 4 p.m. New York time. Now, President Trump's tariff pause has given the U.S. and its trading partners time to negotiate a deal, as Tyler was just saying. In an opinion piece in his outlet, Politico, Axel Springer CEO Matthias Döpfner argues for a swift U.S.-EU trade agreement before renegotiating terms with China. He says if Trump is serious about America first, there's one thing he should come to terms with. It shouldn't mean America alone. I'm pleased to say that Matthias joins us now. So excellent to see you. And I'm saying, even before this Politico column, you published a book late last year, which was so prescient, arguing for this idea that the West shouldn't have given China full trade openness, and that there should be change through no trade and heavy tariffs. Matthias, I have to imagine someone from the White House was reading that, because they've embarked on that journey. Has the past 2 weeks helped achieve the goal that you lay out, or complicated it?
Hi, Danny. Thanks for having me. But truly, I think that the developments may help to achieve a surprisingly positive outcome. I think the 90 days pause is absolutely helpful, because we have seen the limits of trade war with everybody. On the other hand, it's pretty obvious that we got to do something with regard to China, and that is very much in the interest of the United States, but also in the interest of Europe. We have to stop that asymmetric trade allowed by the WTO, implementing double standards. China, treated as a developing country, has been able to grow its contribution to world GDP from 3.8 to 18.5% in 20 years. That cannot continue. But if you really want to achieve something that is beneficial for the United States, then you should not do it alone. And that's why I'm proposing a very simple solution.
You shouldn't go at it alone, Matthias, but will you have to go at it alone? Will the U.S. have to go at it alone because of the unpredictability of the nature of the policies we've gotten from President Trump? Of course, that is a feature often in negotiating. But is there a fear that that pushes allies away from the U.S. to achieve the aims that you're laying out?
That could happen, but it may not happen, and I think it will not happen. I would suggest very concretely that we move now in 3 steps. Step 1, that Europe, perhaps ideally under the leadership of the new German Chancellor Friedrich Merz, reaches out to the present administration, negotiating a no-tariff trade deal between Europe and America. If it's not no trade, then it has to be symmetrically low tariffs. And either no tariffs or low tariffs will strengthen these 2 economies, and in return, of course, Europe has to agree on a mutual strategy, trade strategy towards China. And then in step 2, the US and Europe are announcing high prohibitive tariffs towards China. In step 3 then, you sit at the negotiation table representing 800 million citizens, representing the biggest and the 3rd biggest economy in the world, and the leverage that you have in these negotiations in order to achieve something that is really symmetrical, that is beneficial then to the US economy, to the EU economy, but also to a certain degree more attractive for China than a trade war, that is very high. This likelihood is high, and it got higher after the recent events. So although it looks a little bit puzzling and disturbing what we are seeing at the moment, I'm more optimistic than ever that we can really achieve a transatlantic trade alliance as a basis for better policy towards China.
Matthias, I hate to pour cold water over any optimism. I think we need it in this day and age. But you have seen the Spanish Prime Minister head to China and talk about a deepening of ties with China and the EU. There's a summit also planned for July, and EU and China have started to discuss maybe restarting talks over the dispute when it comes to EVs. Does that movement of Europe towards China trouble you then?
Absolutely, and I think that is even another reason why we need a transatlantic solution. We need a transatlantic trade agreement. Otherwise, not only the US will tap into a trade trap, but also it'll force Europe to move closer to China. Europe is already relatively dependent on many levels from China. And if we now basically, through an isolationist approach, push Europe closer to China, I think that's going to be bad for the US economy. It's going to be bad for the European economy because Europe becomes more and more dependent, and the only winner will be China. So we shouldn't let that happen.
Well, Matthias, you don't only just think about these matters, you have to actively put money towards these matters because you make big transatlantic investments like your ownership of Politico, for example. In this moment, does the U.S. look like an attractive investment for you? Would you put more money to work in the region, or would you wait for some of these tensions to play out?
The short answer is absolutely yes. We see that reflected in our figures. We had a very good first quarter, so we are ahead of budget and previous year. And also on a kind of longer term, in a longer term context, I'm a strong believer in the US and on the pragmatism of the United States of America and its people. So I don't see any reason to lose that optimism, honestly.
Well, you might have a little bit more money alongside to do just that. Of course, in September of last year, you had that deal with KKR to split up the business. Do you have any plans for capital injection from that new source of funding coming from KKR?
Well, after the split, that's going to be closed in the next weeks, in any case, until the end of the second quarter. We have a digital media company, a transatlantic digital media company with assets in Europe and in the US that is debt-free. And with that, of course, we have a different time horizon for investments and for entrepreneurial energy. It's not the next quarter's results that are the most important priority. It's the value creation in 3, 4, 5 year time horizons. And that's, of course, a very, very good position to be in. We are absolutely excited about it. We are looking forward to that. And as we have just discussed, of course, Europe remains an important market, but we are already the #1 there. America is full of opportunities, is the biggest media market in the world. So things will also develop in America, hopefully, and we have lots of ideas.
Matthias, unfortunately, we're going to have to end it there. I think we could talk literally all day, so you'll have to come back and join us. Thank you so much for your time this morning. Matthias Döpfner, Axel Springer, CEO. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Let's get you set up for this trading week, a holiday shortened one. Goldman Sachs will be reporting earnings today at about 7:30 U.S. New York time. Bank of America and Citi, those come out tomorrow. Plus, Fed Chair Powell will be speaking at the Economic Club of Chicago on Wednesday. We'll also get retail sales data on Wednesday. We'll also get an ECB rate decision. That comes on Thursday. Let's look at some movers this morning. Apple higher in the pre-market session by more than 5%, with the Trump administration exempting electronics from so-called reciprocal tariffs. And news that came out earlier this hour, Intel nearing a deal to sell a stake in its programmable chips unit to PE firm Silver Lake. Intel up 3.8%. Goldman Sachs also rising ahead of their results, up nearly 2%, with trading on equities really strong from the banks that we've heard from so far. Let's get a quick check on currencies this morning, because yes, risk might be coming back, but the dollar is still weaker this morning. The Bloomberg dollar spot trading at its weakest level so far of the year. Again, the weakness isn't huge, but at what point does that dynamic start to become troubling? Okay, that is it for Bloomberg Brief. Surveillance takes the reins from here on this Monday morning.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
If we've got a world of higher uncertainty, probably higher volatility, slower growth, you've got to adjust the portfolio accordingly.
It's more likely that we revisit the lows than we don't.
It's going to be hard to find a bullish or optimistic investor right now.
We have to be careful not to read too much into one-day moves and extrapolate them into the future.
What we're looking for is a very choppy year, unfortunately.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, following the biggest weekly gain of the year so far, the rally resumes as the likes of Apple and Nvidia secure an exemption from so-called reciprocal tariffs. The president warning that any relief might be short-lived, stressing that nobody is getting off the hook.
The tariffs will be in place in the not-distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future. I'm going to be announcing it over the next week.
China's Ministry of Commerce urging the United States to take a big stride to completely abolishing the wrongful action. Commerce Secretary Howard Lutnick isn't backing down.
They're exempt from the reciprocal tariffs, but they're included in the semiconductor tariffs, which are coming in probably a month or two.
Did you get all that? So the policy volatility continues, going into a week full of earnings, economic data, and another address from the Fed Chair Jay Powell. And so far, this Federal Reserve isn't blinking.
They don't want to own this because why should they? At a certain point, the policy uncertainty is actually not of their doing this time. And it is hard to know whether it's going to be in the near term, and I stress the near term, the inflationary aspect that's going to be the dominant theme or the growth aspect. I will just say this. Anyone hoping for a trade limit up kind of morning when it comes to tech stocks, you aren't seeing that kind of optimism anywhere. You have, for example, Steve Capria over at Deutsche Bank. This is still a sell rallies environment. Max Kettner, who used to be the biggest bull, coming out and saying we remain skeptically and tactically cautious on risk assets, especially in the U.S.
So we've got earnings data and Chairman Powell. Let's pick up on one Fed official over the weekend, Neil Kashkari of the Minneapolis Fed. I think investors in the U.S. and around the world are trying to determine what is the new normal in America. He goes on to say, we have zero ability to affect that destination.
Then he was talking about how J.P. Morgan and BlackRock were talking about how potentially you could see a 5% benchmark 10-year Treasury yield, and that is maybe price discovery. At what point does volatility become dysfunction? That is the ultimate question for a Federal Reserve, when people largely believe they will only intervene if there is market dysfunction. So far, the pipes seem to be working. I read one note over the weekend saying the house is burning down, but the pipes are still functional. There is this feeling right now they aren't going to get involved. They really don't want to get involved. But people don't believe that they won't get involved if you reach a certain level.
Do you want some good news this morning? So last week, 2-year and 10-year saw a move of 40 to 50 basis points higher on bond yields. This morning, Lisa, we're down 5 at the front end. On a 10-year, we're down 5. On a 30-year, we're down 2. Bob Michael of JP Morgan Asset Management was looking for this, just a little bit of stability to start the week.
He saw most of the sell-off that was pretty catastrophic last week for the bond market as largely leverage trade unwinds. And this, to me, is really the ultimate question. How much is this a positioning shock? And how much is this a fundamental reassessment of American assets? Right now, the only caveat to that is the dollar continuing to weaken at a time when it isn't exactly a risk-roaring, risk-on type of moment. But you're right. The fact that there's a bid into treasuries has to be a sigh of relief.
The dollar a whole lot weaker against the euro. Euro-dollar right now, 113.80. Coming up this hour, we'll catch up with Steve Chevron of Federated, staying overweight equities. Ed Mills of Raymond James on this weekend's confusion. And Krishna Gua of Evercore on what he calls an ugly combination of market moves. We begin this hour with stocks rising as President Donald Trump pauses tech tariffs. Steve Chevron of Federated Hermes staying the course, writing, we're maintaining a modest overweight to equities and are looking for opportunities to upgrade portfolio quality. Steve joins us now for more. Steve, good morning. Good to see you. What do you make of the confusion over the weekend?
We're not done. I mean, I think that's the story. I think what we saw last week were two important things. One, what was the primary objective of the tariffs? And it was clear that the non-negotiable element here was China and the national security element of tariffs. This administration is insecure about our security, particularly when it relates to key goods that we source from China. I think the second thing is we probably, it's a big word, but probably took off financial crisis risk when Trump de-escalated a little bit on the rest of the world. I think the one caveat to that is that 10-year. We need to make sure that that's well behaved. If it really is a story of unwinding leverage trades and that's the end of it, then that should run its course and we should get to a stable bond market. If there's something else that's going on, then we may need Fed intervention, but we're not there yet.
Do you think it's one or the other at this point? And what are you looking for that gives you a strong indication of that?
I think it's a lot of little things, if you will, on a treasury market that's not as liquid and more fragile than you think it is, right? So part of it is unwinding of basis trades. Part of it is meeting margin calls. I'm sure there was some foreign selling to kind of add on. I don't think that was the prime driver, but I think there was some add-on there. And so I think if you're looking for one big thing, you're not going to find it. It's a number of little things on a market that, quite frankly, needs some improvement. And I hope that when this episode's over, the Fed will take some steps to address liquidity in the treasury market.
There are two aspects here. Yeah. On one hand, you have this question about the American safe haven status and this question of American exceptionalism. And on the flip side, you have this issue of whether treasuries can rally into some sort of weakening outlook. And that is what we're expecting to see from the earnings coming in. How critical is it to see treasuries rally on weaker data to give stock traders some confidence that we're not in a completely new regime?
Yeah, so you don't really worry, it's probably too strong a word, but you don't really worry about moves in the equity market, right? I mean, the equity markets they're important. I'm certainly an equity person, but they generally don't have that reflexivity that bond markets do. They're not as critical to the financial plumbing. So when you see dysfunction in the treasury market, that catches your attention. This idea, though, of a buyer's strike on U.S. assets, I don't buy it. I don't believe that we live in a world that buys U.S. assets or trades with the U.S. or buys U.S. debt because they like us or because it's kind, right? They do it because they run major trade deficits with it. They do it because there's no substitute to the U.S. consumer. U.S. exceptionalism isn't because we've been nice. It's because all of the Magnificent Seven are magnificently American, and we're the only major economy that still has population growth or working age population growth. So I don't think any of that went away. I think maybe there was some add-on foreign selling. I think what this really had to do with was unwinding of highly leveraged trades.
Given that, do you think it's time to go into some of these tech stocks that got completely beaten up at a time when you still have a tariff regime coming for them, as we heard over the weekend?
So that was our ad at 5,400 on the initial drop. We added large cap growth stocks. If you play this out, right, I think we've taken off those bottom economic opportunities here with at least the pullback on the tariffs around the globe. As you go forward, we're probably past that point of peak uncertainty. I think last week was pretty uncertain. So I think we're probably going to be a little less uncertain than last week. You do have a tax bill coming out that's going to provide some pro-growth. Deregulation is still to come. I think you're going to have a tough earnings season here. But if you think about an economy that's dealing with uncertainty and a little bit of weakness, who in the world is better able to handle that than the very large, enormous cash flow generating tech stocks that are out there that make up that growth index? So that we do think is an area that's going to recover here.
This is an argument that Savita Subramaniam at Bank of America had with us going into the weekend. Do you think we're underestimating the ability of companies on the S&P 500 to adapt to this?
Yes. Let's keep in mind, within our lifetime and not that long of a history, we've seen companies navigate, the near collapse of the entire financial system, and then we turned off the entire economy with a light switch. The fact that we've instituted what amounts to a national sales tax is certainly important for earnings. It's certainly going to hurt earnings estimates, but the idea that these companies can't navigate that, I think, is ridiculous.
The numbers are still huge, though. This came from Paul Ashworth of Capital Economics over the weekend, who said the increase in the headline tariff rate on China specifically remains at 145%, but the effective increase once those exemptions are accounted for is now closer to 106. Still, 106% on Chinese goods.
Yeah, it's not the worst case scenario, but this isn't good in terms of what the previous trade expectation was. I love that you brought up the idea of companies adapting and adjusting, because essentially what we're seeing is sentiment dropping to the weakest levels that we've seen, both among companies as well as consumers, going back to all of those great depressions and recessions, et cetera. And yet there is this still sanguine outlook. And how do you pair those two, which seem like they're contradictory, the words versus the actions?
We haven't seen the hard data hit yet. And there's an anticipation that the hard data will catch down to some very, very weak self-data. How will you and the team navigate that in the weeks to come?
I think there's 2 points. One is the de-escalation around the globe. What was important about that was not that it lowered the overall tariff level, because it was paired with an increase in China. So the overall tariff level was higher, but it gave companies optionality. In the old regime, before the de-escalation around the globe, there was nowhere to go or hide. Now you can. If you need to leave China, you can go to Vietnam potentially once we have a deal. I think the second thing in terms of the hard data, it's going to soften. I think you started to see a preview of that with the CPI and the PPI data next week. And so it would not surprise us, despite having a constructive outlook here, for us to retest the lows on the idea that over the next couple of weeks and maybe months, you're likely to see employment data soften, you're likely to see some of the inflation data, and I think earnings data is going to soften as well. I think that will then provide the basis for your next move up once you've kind of cleared the deck through that economic softness.
You haven't changed your allocation through all of this. Yeah. Everybody else sitting there like, oh, go to cash. This is awful. You've sat there. You've said, no, we're going to be modestly overweight stocks. What would make you rethink that?
What would make me rethink that, if we started seeing less Besant and more Navarro again, I think that would certainly be one. I mean, I think that certainly had a calming influence. So, this idea that you've gotten past peak uncertainty is one. Two, if we were surprised by the downgrade in earnings, we expect earnings are going to come down, somewhere in the neighborhood of probably 5 to 10%. Anything outside of that. But again, what I step back to is this, and we were talking about this before we went on the air. The moment you accept a fee, you're no longer allowed to be afraid, right? That's what we provide for that fee, is to be clear-headed about it. And what you have here is a tax with other offsetting tax cuts potentially coming and deregulation, and companies that have proven that they can navigate this over time. And we don't think that that changes the long-term outlook for the earnings power of these companies. They will adjust around this.
Level-headed. Steve, it's good to see you, as always. Steve Chevron there of Federated Hermes. I've got some more good news for Steve. A little bit later on, you'll see more of Secretary Scott Bessent, the Treasury Secretary, sitting down with Anne-Marie in Argentina. They will be speaking at 4 p.m. Eastern Time, so don't miss that conversation a little bit later. Equity futures on the S&P 500 here up by 1.2% with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Donald Trump pledged that he will still apply tariffs to phones, computers, and popular consumer electronics. The comments downplayed a weekend exemption as a procedural step in his overall push to remake U.S. trade. The president told reporters aboard Air Force One that his decision will come soon. Goldman Sachs and UBS see more upside for gold in their most recent calls. UBS sees $3,500 an ounce by year end. For Goldman Sachs, it's $4,000 an ounce by mid-2026. The strategists both cited strong central bank demand and gold's role as a hedge against recession and geopolitical risk. And in sports, Rory McIlroy has added the long, elusive green jacket to his resume with a win at the Masters. McIlroy ended a decade-long major drought in dramatic fashion, recovering from two double bogeys to reach a playoff round against Justin Rose. McIlroy then hit a stunning drive to set up birdie on the 18th hole, beating Rose by just one stroke. The win marks his 5th major title. He's now the 6th ever player to achieve a career Grand Slam. And that's your brief, John.
Danny, thank you, and massive congratulations to Rory McIlroy and the team. CBS and Jim Nantz doing a phenomenal job through those 4 days. Jim Nantz put it best. Rory has his masterpiece. If you can take 2 things away from the weekend, the resilience of Rory McIlroy, the grace of Justin Rose. Just absolutely wonderful to see yesterday evening.
I was impressed that you came in last night because I expected you to be watching this game, and I know that you sacrificed, but it came out for you, so I just want to offer you congratulations for a well-waited-for victory.
I raced to the car and watched the playoff.
I imagine that was the case.
I wish it hadn't gone to a playoff, but I raced to the car to
So you got to
watch
watch
the playoff.
it, so it's a good thing.
Just congratulations, Rory McIlroy. Just absolutely phenomenal. Up next on the program, the president attempting to keep the pressure on.
The tariffs will be in place in the not-distant future, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on. We'll be doing that with semiconductors, with chips, and numerous other things.
Up next on the program, Ed Mills of Raymond James, live from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Stuart Kaiser of Citi called in last week the least enjoyable 5% move on the S&P in recent memory. Equity futures had some weight to that rally, up by more than 1% on the S&P 500. On the Nasdaq, up by 1.4. Last week, the Nasdaq 100 up by 7.43%. Just amazing to see. Under surveillance this morning, the president attempting to keep the pressure on.
The tariffs will be in place in the not-distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future. I'm going to be announcing it over the next week.
So here's the latest this morning. President Trump indicating exemptions on electronics announced over the weekend will be short-lived and stressing, quote, nobody is getting off the hook. Bloomberg's Tyler Kendall back with us this morning. Tyler, good morning. Put it all together for us then. Just where are we and what are we expecting to be announced in the next week or so?
Yeah, hey, John, good morning. So it's unclear how long this temporary reprieve will last because it does appear that these tech imports will be subject to a Section 232 investigation, which could take weeks or even months. And we have to keep in mind that when President Trump signed that original executive order on April 2nd, it always excluded chips as well as those other key industries that you just heard him mention there, including pharmaceuticals, copper, lumber, these sectors that could be subject to separate tariffs on the basis of national security concerns. And it now appears that those tech imports, including those consumer electronics, will be subject to these sector-specific tariffs instead of the so-called reciprocal tariff plan. As President Trump said, they're just moving from one bucket to another bucket. But when it comes to this Section 232 tariffs, when the White House has imposed them before, including on steel and aluminum, also auto imports, they've gone into effect at a 25% rate. President Trump declined to say if that would be the rate, but it likely will be around there, or at least lower than what we've seen they could have faced under, for example, the 145% tariff now facing Chinese imports. But still considered to be pretty punitive nonetheless, especially when you think that how these sector-specific tariffs are designed to be stacked on top of other levies. Now, John, importantly, this temporary reprieve applies to about $390 billion worth of U.S. imports. About a quarter of those come from China. So as these companies really look at their supply chains that are concentrated in China, they're going to be lobbying this administration for any sort of carve-out. It's something that President Trump did signal a willingness to engage with these companies on, saying that he wants to be flexible. It just remains to be seen just how flexible he really will be.
Tyler Kendall with the update down in Washington, D.C. Tyler, thank you. Lisa, how flexible will the president be? Some encouragement, I think, going into the weekend, coming out the other side, a little bit of confusion.
I think confusion is the right word. I mean, you have Howard Lutnick coming out and saying that ultimately they want a sphere, some kind of set of regulations around semiconductors to bring jobs back. You had the same message from Jameson Greer. Then you had the agricultural secretary coming out and saying, I do believe this will be a short-term negotiation period, and then we'll move into, again, the economy opening up. Pick your poison.
Joining us now to discuss is Ed Mills of Raymond James. Ed, welcome to the program, sir. The take on Wall Street is that we're witnessing a bit of a policy pivot from the administration away from the markets. Your focus right now, what are you telling clients? You seeing that pivot or not?
Not yet. I do think that there is an old saying here in D.C. that things are never as bad as you fear, nor as good as you hope. We got maybe as good as you hope on Friday night with those exclusions, and only to be reminded that there's going to be tariffs on semiconductors and, quote, other things that are coming in the Section 232 investigations. What I've told folks at Raymond James is that there's three buckets. Number one, kind of that global tariff that's getting revenue for these tax cuts. Number two, it's national security, which is what we're talking about here. And number three, those reciprocal tariffs really are about trying to get other countries to change their policies. So moving some of the semiconductors and other electronics from that policy change over to the national security is a relief from the 145% in China. But I have to remind folks at Raymond James is that those national security tariffs are probably going to be stickier, and it's going to be very hard to negotiate those away, John.
So where does the fentanyl bucket go into the national security, as well as the trade rejiggering, as well as the revenue buckets?
Yeah, I put the fentanyl bucket into that bucket 3 policy change, because if Mexico, China, Canada is included, never really understood why. If they're able to make policy changes in each of those countries, Donald Trump says those go away. I think the fentanyl for Canada, Mexico is really about trying to move forward the USMCA negotiation. Again, a policy-related change that Donald Trump is seeking, Lisa.
There are a lot of people who are on board with a lot of these goals. In fact, there are bipartisan support pretty much across the board, particularly for national security. Larger questions about how it's being rolled out and whether we actually know what the given tariff rate is at any given time. Ed, do you have a sense of what the actual tariff rate is, whether it's on China or whether it's on Europe?
I have what the executive orders and what the U.S. Customs and Border Patrol tells me. But when I talk to companies here at Raymond James, they tell me they don't know how to plan for this. That if they move kind of production from one country to another, is that tariff rate going to stick a week from now, a month from now, a year from now? And so, while there is some relief, if companies don't know what their tariff rate is anytime into the future, they just hold steady. They don't make changes. And another thing that I've heard from a number of companies is that if they move production to the United States, because of the costs of goods sold, these raw materials are actually going to have higher tariff rates than the finished goods in a number of instances, is actually a hindrance to getting things moved to the United States at this point.
Ed, we started the conversation this morning with an investor who at the moment is still bullish and overweight US equities. Lisa asked him what it would take him to become bearish, and he said more Navarro and less Besson. From your standpoint, how important is the personnel issue at the moment, and how have things changed over the past few weeks?
Yeah, we've told folks at Raymond James here that there's two teams, Team Econ, Team Tariff. It was very clear that Team Tariff was driving the bus for the last month. In the last week, it's gone more to Team Econ. That's a good policy shift from my perspective. The problem that I continue to have is even though it's over at Team Econ, we still have 145% tariff on about 75+ % of goods coming out of China. We have a global tariff of 10%. We have tariffs coming on semiconductors and, quote, other things, pharmaceuticals. Jameson Greer yesterday said a lot of those investigations might actually already be ongoing. And so, yes, I get a little bit of comfort moving over to Team Besant and Team Econ, but the tariffs that are in place right now are much higher than anyone would have anticipated. And if Donald Trump just started with this, it would have been freak out. It's just because he's moved the goalpost so far that it seems like relief when it's only 25% or it's only 125%, depending on which country you're talking about.
As we have these two camps that are battling it out in terms of the cabinet of Donald Trump, how much are your companies that you talk to worried about a diminishing of the American brand? And I say this at a time where the dollar is weakening yet again. This could be a positive for companies. It could increase potentially their exports. It also could be a negative if you see something that we've seen with respect to Tesla sales overseas percolate into other industries. How much does that come up with you?
It hasn't come up as much as I would expect. I think there is more of a question about what is Donald Trump's endgame. And one of the things that we've noticed in the market and noticed in conversations here at Raymond James is that the more that Donald Trump seems to double down, the more investors think this is an unsustainable path forward and ask me a lot more questions about how does the courts end this? How does Congress step in and end this? So it is a risk, and there certainly could be some diminishment. But the more that is pursued, the more that people are looking for escape valves. And I think there's a really good court case, or there's a real political pressure that gets on Congress if this does go too far.
Ed Mills of Raymond James, I'd appreciate your time, sir. Thank you. Just yesterday, we caught up with Libby Cantrell of PIMCO. Libby Cantrell said almost exactly the same thing about the release valve that could be used down in Washington, D.C.
She said the big news over the weekend was that the exemptions that were announced on Friday essentially made this president more vulnerable to using IEEPA, the Emergency Powers Act, to enact some of these tariffs, the 145% tariffs on China. So it actually undermined and weakened their case to really be able to execute this. If it is an emergency national security issue, why do they have to give an exemption to 20% of all of the exports coming into the country?
It's a good point. It's a question she asked as well. Equity futures this morning positive still. We'll see if this holds. We're just about holding right now, up by a little more than 1% on the S&P 500. Up next on the program, Mita Richardson of ADP as tariffs weigh on consumer sentiment. You, Mitch, was ugly, ugly, ugly going into the weekend. We'll break down that economic data in just a moment.
in case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Last week, posting the best week of the year so far on the S&P 500. Equity futures add to that, up by 1.2% on the S&P. On the Nasdaq 100 this morning, up by 1.4, with 3 hours until the opening bell. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. Apple leading the gains amid that tech outperformance with the exemption for electronics from tariffs, as temporary as that might seem to be. So Apple up just under 5% this morning, but keep in mind this thing is down more than 20% from its peak. So a lot of bad news already priced in. KeyBank raising its call on tech, saying that the actions from the administration over the weekend remove a key risk. But I don't think a lot of people would agree with this. They are not out of the woods yet. Intel also rallying with the rest of tech, but getting an extra boost this morning from Bloomberg sources telling us that they're going to be selling the programmable chips unit to the PE firm Silver Lake. Those shares up 4.5%. Sources say, though, that the deal is not final and it could still get derailed. And we have certainly seen a lot of deals get derailed because of market volatility. Finally, just rounding things out with a check on where Goldman Sachs stands this morning. It is higher in the pre-market session, 2%. We're going to get earnings from them in about an hour's time at 7:30 a.m. Eastern. We had strong results from their peers, especially when it came to equity trading. So that's the bar for Goldman Sachs. John.
Danny, thank you. Decent numbers from both Morgan Stanley and JP Morgan going into the weekend. On our radar this morning, President Donald Trump pledging to apply tariffs to chips, phones, computers, and other consumer electronics, writing, quote, "Nobody is getting off the hook." His comments coming after he announced a tech tariff pause over the weekend.
So clear as mud. And this is basically what everyone's talking about, the fact that we're not necessarily getting a sense of exactly what the path is going forward. A key question to me is, how do you escalate? And you raised this question yesterday. Is this sort of peak escalation given the fact that China is saying, look, you know, at this point it's silly. This is a joke. You raise it beyond 445%. We're basically just making up numbers here. Can it get worse? What about the rare earths metals? What about some of the other exports? What is the leverage that each side has at a time where both economies are still intricately connected to one another?
I think on the margin, to your point, there are other things they can do. It can get worse. I think the focus, though, will shift to other things, and it's the economic data. The damage done to the soft data is real. It's been building now for a number of months. And there are some people who believe that the damage to the hard data is unavoidable at this point. And my focus is certainly shifting to try and understand what that's going to look like in the next few months.
You saw that this morning with Morgan Stanley, among others, coming out and downgrading their expectations for EPS as we come into this earnings season. That is the first data you're going to see it in. That is going to be the hard data. The companies talking about near-term disruptions in demand. We saw that from Delta. If you read through their earnings transcript, they talk about how domestic travel has really taken a hit, how you're not seeing that kind of filling up. And I have to say, I took a plane recently, and I was shocked at how empty it was. Anecdotally, these planes used to be packed to the gills, and now you're actually getting upgrades. I mean, it's a very strange moment.
I've heard the same thing. We'll hear from United a little bit later on. Good for you getting the upgrades, though. Let's get to the data from China. China's exports rebounding in March with near record shipments flowing to Southeast Asia. The Customs Authority saying exports rose 12.4% from a year earlier, reversing a 3% decline in the month of February. Lisa, you made the point out on X earlier on this morning, I think. It's important to look at exports, sure, But imports tell you a story as well in China, and it's not a great one.
So Brad Setzer, who used to work at the Treasury Department and is really an analyst in terms of trade dynamics, put out a series of charts saying that China's trade surplus has skyrocketed over the past few quarters and has not just been with the United States. It's pretty much tracked with the EU as well. So people who say this is all due to companies front-loading imports from China to get ahead of tariffs, that's not the whole story. It's also that China is not importing anything from anyone. This could be one of two things. One, a focus on nationalism and focus on their national brands. And two, and this is a key one, the economy still isn't recovering. How do you juice demand at a time where it's still flat on its back? And that is a big piece of this story as well.
The Treasury Secretary pushing aggressively for China to rebalance their economy, and no real signs of that happening just yet. We're going to see a bunch of negotiations take place over the next month or so. Japan's Prime Minister saying he won't rush to compromise with the US in high-stakes trade negotiations this week. Local media reporting the country's economic revitalization minister will be heading to Washington on Wednesday.
So a couple of things here. First of all, over the weekend, we did hear from one of the leaders in Japan saying that they were not going to use U.S. treasuries and selling U.S. treasuries as a negotiating tool. So people who are suspecting that Japan was behind the turmoil, you can back off. That's basically what they were saying with number one. Number two, what's interesting is they have somehow gotten a hearing with Scott Bessent, which a lot of people think is a very positive sign in terms of their ability to get some sort of exemption. I love that people are using Bessent versus Navarro as the litmus test of whether things are making progress or not, but here we are.
We're baking down trading to risk on, risk off based on whether you see Navarro or Bessent.
I
how
think
this works now?
Pretty much we're going to have a tally where it's, Bessent appearances, risk on, Navarro.
Risk on right now, for equities at least. Equity futures positive by more than 1% on the S&P. If you are just joining us, if you're looking for stability in the bond market, you've got it at the moment. We're down across the board here, across the curve. We're down 6 or 7 basis points at the front end. On a 10-year maturity, the yield is down 6 to, let's call it 4.43. Let's turn to the economy. US consumer sentiment falling to its second weakest reading on record, while inflation expectations soar to multi-decade highs. Nita Richardson of ADP writing, inflation has made consumers cautious, but rising incomes can help cushion any tariff-driven price increases if they come. Nita joins us now for more. Nita, good morning.
Good morning.
Let's just focus on the data and get away from the politics. Are incomes still rising?
You know, we're seeing that when we look at payroll at ADP, they're certainly rising, not as fast as they were 2 years ago, but at a healthy clip, faster than before the pandemic. There's also a different source of income that's really important to think about, which is the housing market. We get housing starts later this week. Home equity for homeowners is up almost 9% from a year ago. So no, it's not the highest home equity we've seen on record, but it's close. It's like the third highest. And so that's another level of cushion. I don't mean to be too Pollyanna on a Monday, but I also want to give a real data reality check to all the uncertainty that's out there in the market.
I was just going to say, you're not complying with the narrative. I love it. I think it's great. And I think it's good to push back against it because there's so much gloom and doom about companies who are frozen, who aren't going to be hiring. They're not going to be firing, but job mobility just isn't there. You're still seeing just some signs that consumers are maintaining resilience through other means, even with the stock market that maybe rallied last week, but certainly didn't feel like it, and even with the idea that it might be harder to get a raise.
You know, I don't discount the sentiment because sentiment usually triggers certain behaviors, and you see downbeat sentiment with consumers, with home builders, with CEOs. Everywhere you go, there is a pessimism in the outlook. But then when you turn to the raw data, this week is super important. Why? This is the reference week. This is the week that the BLS will start counting the number of people who got paid for for their employment report. And this is the week that ADP will report in 2 weeks to talk about the labor market. And if you look at this week and you compare it to March, what you're seeing is that hiring is still solid. And if you look at one area of sentiment that is holding up, worker sentiment, we're actually going to produce a worker sentiment index tomorrow, publish it at adpresearch.com. What you'll see is that while consumers are downbeat, workers are highly engaged. They're plugged in. Maybe it's because they're cautious about their job loss, but they're showing up, they are engaged, and they are productive, and they're doing so because they want to make sure that they keep those jobs as they move into the rest of the year.
So quiet quitting has died, basically, is what you're saying, which is actually
We're seeing less
really
of it.
welcome. That's fantastic.
We're seeing less of it.
I'm curious. You say that hiring is remaining solid. Is it in specific industries that give you a sense of potentially whether this is a resilience factor or whether this is people getting old and needing to cater to them of getting factor?
Yeah, that's a great question because we really do see a good news, bad news scenario there. We're seeing hiring across firm sizes. That's good news, especially if you look at small businesses who are price takers in the global input market. We're seeing solid hiring across the board, but not every industry. In fact, if you look at consumer-facing industries that are somewhat discretionary, like leisure and hospitality, it's been weaker. If you look at retail, also weaker. So we're seeing hiring in, ironically, manufacturing. So we don't know if that's pull forward hiring to get ahead of some of these tariff and trade changes, or if this is a real rebound. And we're seeing it in B2B services, but not so much in consumer-facing industries. That is a sea change, and it's tied directly to consumers and how they're feeling about the economy.
You talked about the importance of expectations. Let's talk about how consumers are feeling about this economy. You mentioned out on Friday, consumer sentiment, almost 3-year low. Inflation expectations, multi-decade highs. Unemployment expectations, the worst since 2009. Are you seeing anything in the hard data to validate consumer confidence that weak, that poor, that we saw on Friday?
On the labor market, no. Layoffs are at, a 2-year low. They continue to hover around those 2-year lows in the private sector. Different for the federal government, but in the private sector, we are not seeing that kind of upturn and upheaval and pause in hiring that is being projected or picked up in the sentiment. Now, things can change rapidly. I'm not saying that the outlook that we're seeing right now is going to be consistent 6 months from now, but if you're looking at the starting point and the baseline, you're seeing, and I think Chair Powell said this in his recent remarks, a labor market that is solid and continues to perform.
Still this massive spread, Lisa, between the soft and hard data. I keep going back to that headline from you, Mitch. To see unemployment expectations down at the worst levels we've seen since 2009 is pretty staggering.
It was funny, you were mentioning that in the past couple of weeks. Lori Calvasina put that out in a report saying that in all of the earnings calls, also corporate executives have been talking about how this reminds them of 2008, this reminds them of 2020, this reminds them before that of the 2000s. You see that in the AAII sentiment survey as well. So at a certain point, have we really reached a new paradigm shift, though, where suddenly the soft data has not been predictive of the hard data? Or are we going back to something more normal, where you would normally see a correlation there?
So the Federal Reserve's not blinking, and neither the Federal Reserve will be meeting in early May. That meeting concludes. We'll get that decision on May 7th. What do you make of how they've navigated things so far, and what would you expect to see in a few weeks' time?
I think the Fed has navigated the way Main Street has. They're waiting and watching. There hasn't been any big money moves that we can identify. And I think it's too early on the policy front to make any firm movements. And that's what you're seeing from the Fed. But it's also what you're seeing from small businesses and medium-sized businesses who can't change operations on a dime. Consumers can't change spending patterns on a dime. So what you're seeing is an economy that started from a solid baseline in wait-and-see mode, just like the Fed.
There was this discussion that we had, and it was off air, about whether this Fed is going to be really just targeting dysfunction in the Treasury market or whether they actually were going to be looking at levels. We're not going to close the spreads until the spreads get too wide, and then we're going to close them akin to maybe what the ECB has been doing. I am curious about this theory that Neil Kashkari put out over the weekend, saying that we at the Fed have zero ability to affect that destination of 10-year yields as investors try to get some sort of price discovery here. Do you believe that, or do you think that there is a level at which they do step in?
Well, I think this comes to your sentiment momentum distinction. I mean, the Fed operates at the short end of the curve. That is their mandate. And so I think if you take the literal interpretation of the Fed's actions, yes, they're not responsible for the longer end of the curve. But we know that the Fed has a huge sentiment role in all of this in itself. And just by their forward guidance, they can change the way the bond market reacts. So yes and no, hard and soft. We're still back in that distinction.
So I guess to sum it all up, do you see the unemployment rate rising quickly enough to get the Fed engaged in terms of cutting rates or having some sort of stimulative effort in the near term, in the next 2 weeks, the next 3 weeks, before, or the next 2 months, right before the economy really can turn?
Not in the next month, no. we have not seen the transmission mechanism multiply to an effect that it hits the real economy in a way that you would see the kind of staggering job loss that would justify on its own a rate move by the Fed. The labor market is still holding up. 209,000 private sector jobs created, according to the federal government last month. That's not going to be a downbeat measure by anyone's estimation.
Nita, it's good to see you. As always, thanks for dropping by. Nita Richardson there of ADP. Step one of the Federal Reserve is to pledge to anchor inflation expectations. Step two, they've basically told us if unemployment breaks, to Nita's point, they're going to step in. We saw that last summer. At the moment, that's not breaking at all.
And it's unlikely that it's going to break, at least in the near term, even as people ratchet down their recession calls. At the same time, they also have this off-ramp of dysfunction. Define dysfunction. Good luck. Have a good time. Say that it's necessarily some sort of failed trades. That's not happening. Say it reaches 5%. Well, they're not saying that, but, you know, things change when sentiment changes.
Is anyone having a good time at the moment? I'm not sure they had a good time last week, even with that 5 to 6% move in the equity market.
So to me, the idea that Jim Reed and Henry Allen at Deutsche Bank put out was really telling. That financial markets experienced one of their most tumultuous periods in living memory. That last week, we saw the biggest sell-off since 2020. We saw the biggest rally since 2008. We saw the biggest weekly surge in 10-year Treasury yields going back to 2001, and the biggest surge in 30-year yields going back to 1987. Are you having fun yet?
It was that FX bond mix that got a lot of people concerned, right? That 50 basis point move we saw on a 10-year yield higher, together with the weakness we saw in the FX market, dollar weaker. This morning, if you want an update, the dollar weakness continues, but in the bond market, some stability. The 2-year yield is down by 6 basis points. The 10-year is down by 6. Your 10-year at about 443. With an update on stories elsewhere this morning, let's get your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Police have arrested and charged a 38-year-old man after an attack on the Pennsylvania governor's mansion, where Governor Josh Shapiro and his family live. Suspect Cody Ballmer turned himself in and faces charges including arson, attempted murder, and terrorism. Shapiro and his family were evacuated early Sunday morning and are unharmed. Elsewhere, Meta faces a landmark antitrust trial today. The FTC alleges that the tech giant acquired Instagram and WhatsApp to eliminate competition and maintain a monopoly. Meta says the acquisitions were approved by regulators over a decade ago. And Dubai topped Heathrow as the world's busiest international airport, that from the Airports Council International. The Gulf Airport handled 92 million travelers last year, up 6% compared with 2023. Heathrow, in second place, handled about 79 million passengers. And that's your brief, John.
Danny, thank you. More from Danny later on in the program. Up next, a shakeout in the bond market.
From our perspective, we're seeing a complete deleveraging of positions, whether it's been swap spread trades, whether it's been the Treasury basis, all those things have begun to unwind, and it's put a lot of downward pressure on Treasury prices.
That conversation just around the corner, live from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially. right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up, if you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
no, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins. The Asia Trade, weekdays, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Live from New York City, welcome to the program. Equity futures still positive here, holding on to gains, up by 1.3%. The bigger gains coming from big tech on that tariff exemption, if we can call it that. The president's saying we can't. But ultimately, that's what it looks like. Up by 1.5% on the Nasdaq 100 this morning. Under surveillance this morning, a big shakeout in the bond market.
From our perspective, we're seeing a complete deleveraging of positions, whether it's been swap spread trades, whether it's been the Treasury basis, whether it's been investors who sold Germany and bought the U.S., all those things have begun to unwind, and it's put a lot of downward pressure on Treasury prices. It's a one-time price reset for tariffs that will create demand destruction and lead us to recession.
So here's the latest this morning. U.S. Treasuries looking to rebound after posting their biggest weekly loss in some 2 decades. And of course, Krishna Guha writing the following. There are only 4 other episodes in the last 30 years in which the dollar appreciated, or rather depreciated, more than 1.5%, with the 30-year bond yield at more than 10 basis points. Krishna joins us now for more. And Krishna, we saw that last week. I'd love your view on this situation. How concerned were you at times seeing that kind of price action through last week?
Yeah, very concerned, to be honest. This kind of behavior, yields higher, currency lower, is what you see all the time in emerging markets that come under pressure. It's what you saw in the UK during the Liz Truss debacle. We do not see this kind of behavior in US markets, other than in exceptional times. The one period in the last 30 years where you saw some price action of this kind was shortly after Lehman failed. So this is absolutely not business as usual. And when you see this combination, essentially what it's telling you is global investors are taking money out of the US and reallocating it to foreign markets. That's the only way you get the combination of yields up and currency down. Now, as you say, maybe the market's going to try to consolidate some today, but we need to keep a very close eye on this going forward.
Krishna, how do you determine whether this is a sell America moment versus some sort of leverage trade unwind, which is what a lot of people have been saying?
So I think it's clearly a bit of both, right? And part of the risk right now lies in the scope for interaction between global portfolio reallocation, slightly smaller allocation to the US, increased allocation to other markets, in particular Europe, but not only Europe, Japan, some other places, and the ongoing delevering, degrossing in the hedge fund community around basis swap spreads and so forth, which have so far proceeded relatively orderly. But when these two forces are operating at the same time, there is some additional risk, of course, that this could start to get out of hand, and that's why the Fed certainly would want to keep a close eye on this. Just very quickly, how can I tell you with very high confidence that it's not all leveraged trade unwinds? Well, if it was, it would be yields higher, but it wouldn't be dollar lower. the dollar lower piece has to have a cross-border aspect to it.
There is a cross-border aspect to this question of how much people had overweighted the American exceptionalism story.
Yes.
And this idea that suddenly people are pulling back. And there is this argument being made that it was strange that the dollar was as strong as it was based on the fact that the Fed had cut by 100 basis points and that typically you would see a dollar weakness at that point. But that didn't happen because of this belief in American exceptionalism. At what point can you say this is actually healthy? This actually balances some of the imbalances that came from an overly strong dollar.
Well, again, some dollar moderation in and of itself could be constructive, could help, in terms of the process of rebalancing the U.S. economy and so forth. But dollar depreciation that comes along with rising yields, that is not good news for anything, particularly not for a country that runs a very large structural deficit that might be about to go into a recession, that is considering tax legislation that's likely to increase rather than decrease the deficit, and with some risk that if things get bad enough in terms of the economy and unemployment, that the current administration and its allies in Congress could be tempted to go for broke with still bigger tax cuts. The tricky thing here that is really important to understand is, what is a trade deficit? A trade deficit is a capital surplus. And the actions of the U.S. administration in seeking to draw back from international economic engagement, to threaten its creditors with Mar-a-Lago Accords, user fees, this kind of nonsense, runs the risk that the foreign investors who are a core part of the U.S. Treasury market may have reduced appetite to purchase this debt at precisely the time when there's upside risks to deficits. So it's not that dollar moderation is a problem. It's that we need to think through the interaction of what's going on in the dollar and what's going on in the bond market. In effect, what's going on in the trade account and what's going on in the capital flows.
Begs the question, Krishna, does the Fed actually have a role to play here or not?
Well, the Fed has potentially, of course, two different types of roles. One is to intervene in the Treasury market or adjacent markets like the repo market in the event that there is severe stress on market functioning. That's not linked directly to the level of prices or the level of yields. It's about market functioning, though, of course, when market functioning breaks down, prices can overshoot. The two are not perfectly separated. Right now, market functioning is okay. It's hung in there. It's not great because there's, sort of long one-way traffic, but it's held in okay. And so the Fed on that basis will, I think, continue to hold fire, will only intervene for market functioning purposes if there's a more severe deterioration in market functioning, which could come at any point, but isn't there now.
Krishna.
Separately, of course, the Fed has to deal with the macro impact of all of this.
They've got a lot of work to do potentially on May 7th. And May 7th feels like a lifetime away. It's good to see you, sir. As always, thanks for breaking that down. Join us again soon. Krishna Guha there of Evercore. That's Evercore's view. Deutsche Bank, very direct. George Saravelos over the weekend. If recent disruption in the US Treasury market continues, we see no other option for the Fed but to step in with emergency purchases of treasuries.
Well, we heard the same thing from Bob Michael. At a certain point, they have to step in. At what point that is, they'll feel it out.
Up next on the program, Peter Chia of Academy Securities, Henrietta Trays of Veda Partners, Gerard Cassidy of RBC with Goldman earnings just around the corner, and Vivek Arya of Bank of America from New York City. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
We're building another art museum called the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
There's greater uncertainty around the U.S.
Uncertainty doesn't do it justice.
That max uncertainty that we all keep hoping to get behind just continues on a daily basis.
The market does want to know that there is some put from policymakers. You're completely switching around the world order of the last 40 years.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures gaining by 1.4% on the S&P 500. Some outperformance on the Nasdaq. A relief about exemptions for the likes of Apple and Nvidia. Apparently that relief will be short-lived. Stay tuned for an explanation of that in just a moment. Some good news in the bond market. A lot of you spooked by the moves of last week. This morning, yields are lower by 5 basis points on a 10-year, 443 on 30s. We're down a basis point or 2. This hour, we'll hear more from corporate America. Goldman earnings just around the corner, 30 minutes away. As we work our way through the week, you'll get more economic data and earnings. And Chairman Powell's on the calendar. Chairman Powell speaking this coming Wednesday.
Which potentially could be the main event. The big question for him is, how does he respond to what a lot of people are saying isn't quite dysfunction, but is feeling a little bit like dysfunction? And given the fact that people have typically seen the Fed step in at times of great uncertainty, given the fact that people are drawing analogies to 2008 and 2020, you would expect them to do the same. So far, the answer is not our problem. You deal with it, because right now there is no dysfunction. Ultimately, the other big event to me is going to be earnings and how corporates really guide ahead.
More from Goldman in about 29 minutes' time. Let's sit on that market move. I think it's important. So last week we had a 50 basis point move higher on a 10-year yield. And at the same time, we had a weaker dollar, not a stronger one. The dollar weakening by almost 3%. That spooked people. And they're looking at two options here, Lisa. Either it was a big unwind of trades and a risk aversion period, a big bout of risk aversion, or you're starting to see some leakage as people step away and question the safe haven status of the United States.
And we've heard conflicting things from different people. Some people, like Bob Michael, attributing it much more to some sort of leveraged trade unwind. Jordan Rochester said, regardless of what it is, Trump seeing a watering down of tariffs, but still dollar weakness and U.S. rates still selling off. They were at least late last night in the futures market. He said it's a horrible, toxic combination. And right now, the fact that the dollar is still weakening gives you a sense that maybe something else is still at play, especially given that this rally, certainly in the 30-year, doesn't scream some sort of rebound after the worst weekly sell-off since 1987.
That dollar weakness continues. DXY down by 0.6%. The euro stronger against the weaker dollar. That currency pair 113.86. Coming up this hour, we'll catch up with Peter Cheer of Academy Securities as investors brace for more volatility. Henrietta Trey's of Veda Partners on this weekend's policy confusion, and Gerard Cassidy of RBC reacting to earnings from Goldman Sachs. We begin this hour with stocks higher, looking to build on their best week since 2023. Peter Cheer of Academy Securities writing, for the first time in weeks, I'm optimistic about the outlook for the economy and for markets, but it is tempered slightly by all the measures it took to get here. Pete joins us now for more. Pete, good morning.
Morning.
Where's the encouragement come from?
Well, first I wrote that like at 9 a.m. on Sunday, so I'm probably not quite as encouraged as I was. For me, what I would really like to see is a true pivot towards domestic growth, right? Let's get the CHIPS Act money out there. You know, last Thursday at the cabinet meeting, a couple of the people talked about shipbuilding. I think we have to spend some money, do some things domestic growth, long-term contracts, either with shipbuilders, something to, that we can really get our hands around and grow, build up manufacturing without necessarily having to fight with the rest of the world.
Do you think it's likely we'll see that?
I'm increasingly dubious. I did not like, all the mixed messaging we got on tariffs over the weekend, right? From Friday night, no exemptions to more exemptions. And I think I'm a little bit worried about bond yields as a whole. Partly, I do think foreigners should be selling. I think you can get better yield in your own country. There's all this talk about, potentially fees on foreign holdings, Mar-a-Lago Accord. But beyond that, if you just take away, I think we missed three things last week. The budget for the military, Trump wants to do $1 trillion instead of $800 billion. That's going to add to the budget. We just had very large debt ceiling raises. That gives them the opportunity. And finally, DOGE at the Thursday morning cabinet meeting basically said they're targeting $150 billion for this year instead of $1 trillion. And places like the Wall Street Journal things are reporting that they can't even come up with $150 billion. So we are not on the right track on the deficit, which I think was everyone's big hope. So I think bond yields lead us lower across the board right now until we do something domestic to help growth.
Bond yields lead us lower. Can you elaborate on that? And by the way, coming out and saying that you're optimistic and then this litany of negatives really is just,
He did say he wrote it at 9 o'clock yesterday.
That's true, which gives you a sense of just how quickly things are. So what do you think?
And I was very, 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 so I was thinking, we were like heading towards 20% down from here. It feels like it might be more controlled. I will watch very closely today. This, when we went through the GFC and even the European debt crisis, one thing that always struck me as key when we moved to a new leg of the problem was you'd get the announcement you were hoping for, so in this case, tariff exemptions, and if you don't last a full day on the rally, it tends to mean the market's now looking through that and saying, okay, yeah, these exemptions, whatever, let's look what we actually have on the table, and it's a lot of problems out there. And the other part that makes me a little bit nervous that I think we'll see is if we stick to tariff deals, I think tariff deals are easy. I think we're going to have to go after trade deals. And to me, trade deals will require import quotas, something like that on behalf of these other countries, and possibly restrictions on what they can do with China. I don't think that's going to be that easy for them to digest. So I think we'll learn a lot more in the next this week about deals. Tariff deals, I'm comfortable with. If it goes down trade deals, I think we take another leg lower.
I've seen so many notes where people talk about how exhausted they are and how stressful this period is. And I was thinking about why. And there's this flood of information, and it's hard to understand what structure to even put them in. What have we learned versus just tidbits of information that are coming in at you in rapid fire? Have we learned anything from the turmoil of the past week? Are we past peak uncertainty and heading into something that we can more concretely hold?
So the biggest thing for me that I can't quite figure out, and I think is really critical, is did China get sucked into being more aggressive on tariffs? How we play this out? Did we make it look like it was the U.S. versus everyone? China was more aggressive and now regrets it? Or did we learn that China really doesn't care, that China spent 4 years preparing for this and is really ready for the fight? I lean towards the latter. I will give the people who talk about, art of the deal and 4D chess, that it could be the former. And if it's the former, that's great, because China will have to back off. If it was the latter, we're not really prepared for this at all.
I'm pleased you went there. Is there any sign that China's coming to the table? Do you see anything at all?
No, I think, we have to go back, and we're about 15% of China's exports. And, I think they exempted 25%, whether it lasts or not. But I think that's also looking at it on the raw dollar value. I think from a profit margin, we exempted probably China's most profitable things that they export to us. I don't see them come to the table. I see the rest of the world talking to them. We've been so, and which is very dangerous. And again, if you're in that part of the world, you probably have to play nice with China. Their military is there, their Navy is growing. It's unclear what direction Trump wants to go on some of that. And the rest of the world, I think, is very tired. The uncertainty doesn't do well. And everyone knows it's going to take years to rebuild manufacturing, which is why I go back to I'd be much more optimistic if we started doing things domestic. Maybe we buy $10 billion of Navy ships, but they have to be built in a U.S. shipyard. And that's going to be 10 years of delivery, but it can start that process.
We've talked a lot about the pressure that was put on Europe, and it's pushed Europe to do things that is good for Europe. And I just wonder if this pushes China to do things that is good for China, in line with what the president would actually like to see from China, which is a rebalance of the economy towards domestic consumption. Are you hopeful?
No, I just don't think Chinese consume the way we do. I think, quite frankly, no one consumes the way the U.S. does, right? We consume a lot, and that's another concern about the economy, right? We're seeing some delinquencies tick up with all this uncertainty. I think China's going to try and do what they do, trade with the rest of the world, trade with us, and we're going to figure out where they have the opportunities. Again, they've spent the last 10 years building up 90% of rare earths and critical minerals are refined in China. We can get them anywhere. I think that's not the hard part, whether it's cost justified to get it out of anywhere. It's the refining, and again, that's going to take years. So China's putting all this pressure on us. And again, this was ridiculous 5 years ago, when we talked about this at Academy Securities, the number of things that are really critical to military equipment that we were getting from China when we were having all this friction with China was insane. So bringing those back makes sense, but we've done it in such a way that I think we've left ourselves vulnerable in the meantime.
So it seems like we haven't really gotten much clarity when it comes to understanding the off-ramp between U.S. and China negotiations. We do have a sense, though, of what that off-ramp looks like for President Trump to cater to a market, specifically the Treasury market. And I want to go back to something that you said, which is that you think that the bond market is going to lead the rest of the markets lower from here. Have we learned something about where that Trump put is in terms of what kind of levels of bond yields get him nervous?
A little bit, but I think it was very easy with all the noise last week to talk about this as being foreign selling, this basis trade unwinding, right? So, the Fed said they would, they would protect the bond market, which I think they will. They'll buy some here or there. I don't think we're going QE, but I think it was very easy to think of this as a temporary thing. If the conversation starts turning, as I think it might, that our deficit isn't going away, Doge isn't being as successful as we wanted, we are not being spendthrift, I think that starts putting even domestic pressure on yields and people saying, well, maybe even with inflation coming down, we're not at the right level. So that, to me, would be a bigger problem, right? And it'd be hard then. So what can he do? I'm not sure at that point.
Okay, so if you get to like 475, if we get to 5?
I think they're
I'm trying to come up with structure.
I don't know. I think they're begging the Fed to support. And again, a lot of this happened overnight last time. If it starts happening more and more during the day, that's where I think the fear comes out. But I don't know what he can do other than go keeping flip-flopping on tariffs. Yeah. And it feels like they're kind of tired of flip-flopping on tariffs. And the other part is with this whole deficit, right? We were at one time, and it was always confusing how much of that was going to be the case, but tariffs were going to help reduce our deficit. Well, if that income's not really coming in, where are they going to get other income? And I think they're going to target foreign holders of treasuries. Again, there's talk about delisting some of the Chinese ADRs. I don't see what that really does at this point, but that probably triggers yet another response from China. And I just keep thinking that we expect China to make these simplified moves. We've talked about this before. Xi has learned something. Trump 1.0, Xi was the first one to Mar-a-Lago. Every time Trump said tariffs, they raised their hand, trade delegation. They have played this very differently. So just like Trump administration has had 4 years to plan this, China has had 4 years to plan this, and it's beginning to look like China spent a lot more time and money planning this than the U.S. did.
It doesn't look like a negotiation right now. In fact, Lisa and I were talking about this yesterday. It looks like the U.S. is negotiating potentially with itself at the moment. You're not hearing much back from China. I wanted to finish on one final point with you, because you've been very consistent about this. As we work our way through earnings season, you've really, really raised the flag about the damage being done to the American brand. Not about the attractiveness of U.S. assets, but the attractiveness of U.S. goods, U.S. services. How much damage has actually been done?
I think we're going to see some of that. And this first wave is going to be a little bit difficult to tell whether it's just because of global economic weakness that foreign sales sell down, or you're going to have to start looking, is there an indication that, say, Cadbury, for example, starts doing better than some of our brands overseas? And that, I think, will be the real key. Try and figure out pairs where, okay, here's a European or other brand, and are their sales declining or changing relative to the U.S. brands? And I think that would be a big shock to the system, because I do think people believe, and you can see it in some of the price action today, that there's just this huge demand for our brands globally, and it's only being affected by tariffs. I think we've diminished that as part of this overall, trading strategy, and that's going to be harmful. And I think we may even see some companies talk about it. I think it's too early this quarter, but as this goes on, I think that becomes an issue for the rest of the year.
Interesting. One to watch. Pete, it's good to see you. Thanks for dropping by. Peter Chair there of Academy Securities. Equity futures at the moment near session highs, up by 1.5%, with an update on stories elsewhere. With your Bloomberg Brief, it's Danny Berger. Hey, Danny.
Hey, John. A check on Pfizer shares lower by about 0.5% in the pre-market trade. In a major setback, it will stop developing its obesity pill. Pfizer said that in a clinical trial, there was a potentially drug-related liver injury in one patient. It leaves Pfizer far behind its competitors without an obesity treatment in the market. Elsewhere, Japan's prime minister said that the country is in no rush to compromise with U.S. trade negotiations. The country's chief trade negotiator is set to visit the U.S. Wednesday through Friday and will be discussing levies on cars, agricultural products, and FX with Treasury Secretary Scott Bessent. Citi equity strategists have lowered their view on U.S. equities to neutral from overweight, citing the trade war's impact on economic growth and earnings. The firm joining its Wall Street peers and lowering its year-end target for the S&P 500 to 5,800 from 6,500. And that's your brief. John.
Danny, thank you. More from Danny later on this hour. Up next on the program, a brief sigh of relief for big tech.
The tariffs will be in place in the not-distant future, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on. We'll be doing that with semiconductors, with chips, and numerous other things.
Up next on the program, we'll attempt to make some sense of the announcements from over the weekend. We'll do that with Henrietta Trays of Fader Partners, live from New York City this morning. Good morning.
Going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.